We saw the dollar very much on the back foot. Mark Cudmore thinks we've seen a turning point in the dollar. What do you think? IB plus TV Go if you want to get in touch with the team. The pound, Tom, to your point, 125.13, also pretty flat, but that perhaps tells quite an interesting story. It's been up, it's been down, and now it's back to flat as a result of a sort of lack of conviction, really, of what to do with a hot wages print, but not a great story around job creation in the UK. And in fact, the unemployment story edging up ever so slightly. And this is the Brent crude price. We're up by 0.2%, but over $90 a barrel. That commodity story has been pretty hot of late, Tom.
So those labour market dynamics not impacting the FTSE 100 futures, currently pointing to gains of 0.2%. Mark Cudmore flagging the fact that the 250 is more likely to be in focus. DAX futures flat as we look ahead to the ZEW survey. Anna.
Yeah, absolutely. So lots of data due out, indicators like the ZEW a little bit later on, and we digest the UK market data that we've had already. We'll be looking at that divergence between the 250 and the FTSE to see if there is any expression of weakness domestically, maybe some strength on the international side for UK corporates. So this is the FTSE right now, entirely unchanged at this point. The Spanish IBEX up by 0.2%, perhaps a little bit of catch up to the US session of yesterday and all the strength that we saw around tech names. This is where we are on the FX markets. I put in the dollar on the last chart, so we've seen the dollar is pretty flat. There it is. The pound also pretty flat. Again, interesting in the wake of that data that we had out. The euro actually on the back foot, just down 0.2%. We're waiting for an important meeting of the ECB later on this week. That comes in 2 days' time, so we'll have to wait till then to find out whether we get another 25 basis points hike from the ECB or whether they are done. The jury does seem to still be out on that one. And it's a really mixed picture, Tom, when it comes to sovereign bonds. We're selling some, we're buying others. We've got very muted moves in terms of the yield movement that we're seeing on bond markets. But broadly speaking, then, equity markets opening just on the front foot. US futures, though, are pretty flat, and we're looking for a lot more information this week, aren't we, around the US inflation story, and that doesn't come until tomorrow.
Yeah, this very much feels like a market that is on hold, at least treading water ahead of that key catalyst around CPI. From the US. Across your sectors, we're looking briefly at technology. You're seeing a little bit of upside, of course, because of the story yesterday, the momentum that came through for the NASDAQ. And there's a little bit of read across to the European space here. Tech as a sector currently adding gains of about 0.1%. There's a little bit of movement in the retail space. That sector adding gains of 0.8%. Look to AB Foods and the upgrade there as one of the catalysts for the upside coming through for retail as a sector. Construction materials gaining 0.4%. In the red, though, energy dropping 0.2. We continue, of course, to look at the impact on oil prices, still hovering around that $90 a barrel level for Brent. Really interesting developments in terms of the geopolitics between DC and Tehran and whether or not more Iranian crude can actually flow into these markets and put something of a cap on prices. Food as a sector currently up 0.2%. Travel and leisure getting 0.6. And you're seeing banks gaining as well as autos. Bit of a lift there for the DAX coming through then. Autos as a sector getting 0.5%. Again, across your benchmark here in Europe, you're looking at modest gains of around 0.2%.
Okay, so those are the early moves then we're seeing across European equity markets. Slight positivity to the start of the European session. Let's dive deeper into the main themes attracting attention today and affecting our trading day. Eddie van der Veld from our Markets Live team joins us now with a look at some of the themes in focus. And of course, we're here at the start of the European trading day, but the gains aren't huge, Eddie. So let's step away from the European story for a moment to think about broader sentiments around tech, I suppose, because the ARM IPO certainly getting a lot of attention. What do you read into the hyping that we're getting perhaps around its popularity?
We are certainly getting a lot of hype from the company, right? But I think with reason. I think this is an exciting IPO. This is, a chip company at a time when chip companies are hot. and you're seeing a massive oversubscription to the company, according to all reports. They're probably going to achieve something if they raise their IPO range at the higher end of their initial target, which was something like 60 to 70 billion. This will really tell us. I think this is a macro story, because it will tell us something about how much demand there is out there still for this tech story, even in this environment of higher rates, about the AI story and so on. They have tended to make the chips for the lower end of the market, for mobile phones and so on. So not your AI chips, but I think the company will want to build up its ability to maybe scale up to those higher end chips and the higher cost chips. So I think this will really tell us about just how far that story has yet to run.
Yeah, and Shuli Ren's Bloomberg opinion piece, really fascinating in terms of drawing our attention to the focus between the banks underwriting this IPO and the linkage there to margin loans to SoftBank as well. Really fascinating in terms of that dynamic. When it comes to the jobs data in the UK, Eddie, do you have a clear steer on this? There is a tick up in unemployment. Those who are employed are demanding higher wages, though.
I got to say, I am with Mark Cudmore on this. Talking about a stagflationary development in the UK with these higher wages and slower jobs growth. I think the UK, I don't think this is going to deter the Bank of England from hiking rates at its next meeting, and I don't think the market is going to price accordingly. And I do think that that they will be focused on bringing inflation down initially. But I think that this looks like a steepening trade in the UK, and it looks like you're looking towards utility companies, the sort of companies that can hike their prices, that are maybe have government contracts linked to CPI and RPI at the same time as they have a monopoly over demand. So you're looking at companies like utility companies. Those kind of companies can do very well in this environment. But the UK is an importer of inflation from the rest of the world, right? There are unique situations here. There is the Brexit fallout, and there is the pound to contend with, but it is essentially importing inflation still from the rest of the world. So if we see inflation coming down the rest of the world, the UK will just be behind the curve.
Okay, and let's talk about crypto, Eddie, mostly because we don't do it very often anymore. We don't seem to, and the demise of FTX kind of put that less in focus for us, I suppose. But volatility has picked up. What explains it?
Volatility has picked up the crypto industry, and I think people have forgotten about crypto, right? A little bit, because there is so much focus on AI and on other new technologies. But I think there is reason to think that the crypto industry at the moment is going to be a little bit interesting, because FTX, some of those assets that they built up is going to have to be sold off, and they've got $7 billion worth of cryptocurrencies, and that's investors are now pre-pricing that this is coming back to the market. There's a hearing on Wednesday about this, and if that comes back, I think we saw previously in the Mt. Gox default and so on, that you saw when there's these large scale sales of cryptocurrencies that could put real pressure on prices. And this was a time that cryptocurrencies should have been rallying into next year's halving and so on. So I think it's a really testing moment for the crypto industry, which would have been under a lot of people's radar.
Okay, Eddie, drawing our attention to a testing moment for the crypto space. You're currently looking at upsides for Bitcoin of around, close to 3%, currently trading just above 25,800. MLive's Eddie van der Walt, thank you very much indeed. Let's check in on some of the individual stocks on the move with Joe Easton. Joe.
So we've got a couple of big decliners here in London. Firstly, Feathertree getting slammed down around 7% at the moment on London's AIM market. They did cut their outlook partly due to that weaker weather in the UK, but also due to the increase in glass prices that's hit that firm over the past year. I think they could be on the rocks with some of their investors later today. I tried to fit in some more bad puns today. The other big decliner is Smurfit, down 12%. Anna mentioned that breaking news that the company has agreed to merge with WestRock. That stock now down around 20% since the news broke of those talks. Investors didn't like the synergy outlook there and also questioned the valuation as well. So those are the big movers in London. It's also listed in Dublin, so we'll wait for the stock to open on that one. Primark owner AB Foods getting a lift up around 1%. Their outlook is better than expected, but mostly driven by Europe. The UK continues to be a weak spot for them. And I've brought up MTU Aero. Now, this one fell 12% yesterday. They're in a partnership with Pratt & Whitney, the Raytheon unit over in the US on engines, and they had a warning yesterday, could be facing a €1 billion hit from some of those issues there. But that one unchanged, still nursing that loss from yesterday. In terms of a couple of the other sectors we had in focus, now the UK market, of course, is keenly watched given that wage data. UK yields were indicated higher on the open. I'm seeing Taylor Wimpey up around 0.6% and Lloyd's also gaining those, so not a huge impact there. In terms of the read across from Oracle, SAP was indicated lower, and that one is declining, seems to be the one that has the most read across from the cloud business. Oracle, of course, fell around 9% in the US after the market closed yesterday. On the analyst rating front, there's a few interesting ones this morning. So we had Jet2. Now this one gets a new overweight rating at Morgan Stanley. Morgan Stanley says the package holiday market is where the money should be going in terms of travel. Because of the cost of living crisis, people are looking to cut those costs and therefore more likely to book all-inclusive, according to Morgan Stanley. Also coincident for me, because I'm going on holiday tomorrow. I'll be hitting that all-inclusive buffet, no doubt. Now, HelloFresh, they get a positive catalyst watch at JP Morgan, who says that they're growing market share in the US and also ready to eat. So HelloFresh, known for their packages that you make at home, they've also moved into pre-prepared, and JP Morgan says that could boost the stock. That one moving higher. L'Oreal gets a downgrade at Deutsche Bank. Deutsche Bank says that the company is losing some share in China, and generally the Chinese exposed companies are seeing a bit of a decline, according to the firm. L'Oreal shares not worth it, according to Deutsche Bank. And finally, Sandvik. Now this one is a new underway over at Barclays. They are a mining machinery company exposed to the gold industry, which is a weaker sector at the moment, and that one is declining over in Stockholm.
Joe, thank you very much. Joe Easton from our equities team with the day's market moves and some puns and some information about his holidays. We thank him for that. Coming up on the programme is Morgan Stanley, the last bull standing on treasuries as a number of Wall Street peers shift. We discuss with Laureline Chatelain from Pictet Wealth Management. We'll get the view from Pictet on the bond market. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
The markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Growth is slowing. This morning we present the forecast, and the forecast is for 23 of growth of 0.8%. Is this something of long duration, where our estimate is that we will have probably a rebound already next year? So this is why I would not call it abruptly stagflation. It's a moment of easing growth for sure.
EU Commissioner Paolo Gentiloni on the economic outlook for the euro area this year. Of course, their forecasts were cut to 0.8% growth from 1.1% yesterday. Checking in on these European debt markets. Before we get there, gilts, by the way, in the UK, yields actually coming in by about 2 basis points, despite that reminder around the record wage print coming through. But the headline unemployment number did tick up. So you're seeing yields coming in by about 2 basis points. The 10-year at 4.45. Over in Germany, you can see the 10-year there at 2.62. Not a lot of movement. Yields just edging lower by about 1 basis points. And 3.16 on your French oats. And over in Italy, BTP's 4.37, close to 2 basis point move. Again, not extreme moves as we really wait for that CPI print out of the US, of course, tomorrow as a key driver potentially for these debt markets, Anna.
Okay, let's talk about bond markets globally. Let's speak to Laureline Renaud-Chatelain, who's fixed income strategist at Pictet Wealth Management, and joins us now. Laureline, very nice to have you with us. Let me start with your call on treasuries, your overweight US treasuries, but I imagine there's a lot more nuance to it. What is it that you like about US treasuries, or where exactly on the curve do you like US treasuries right now?
Good morning. Thank you for having me. So regarding our overweight US Treasuries, we have had it for a few months now. The view that we hold is that above 4%, we see yields as attractive, first in terms of real yields, because we expect inflation to continue to come down, and also as a protection against economic slowdown that we still expect to take place in the US, although potentially the recession will come earlier next year and not this year as we previously forecasted. So we see it as a safe haven protection in portfolio.
A protection safe haven with yields above 4% and pushing out your view for a US recession into potentially the first quarter of next year. If that gets pushed out further, and we continue again to hear from the US Treasury Secretary, the glide path to a soft landing, inflation pointing in the right direction were the lines from Janet Yellen, of course, paraphrasing. Goldman Sachs, 15% chance of a recession. If you have to push back that recession call, Laureline, are you going to rethink that overweight on treasuries?
No, at this stage we don't. I guess the most important part for reflection is also inflation. So we would be more worried if we see core inflation not coming down as we still expect it to do. That would be a risk to our scenario. The other risk will be really linked to the fiscal deficit. And we know that more issuance is coming to the market. And if we have no clear view that actually the deficit is going to actually go a bit higher going forwards in 2024, then that's going to be a problem for the treasury market.
Laureline, just sticking with treasuries for a moment, how would you expect the market to trade around the CPI print that comes tomorrow? This is the key piece of economic data this week. Our colleague Mark Cudmore earlier was telling us that a lot of people are concerned about hot inflation prints, and therefore that seems to be the risk on the market's mind. How are you thinking about this inflation print?
So I guess the headline is likely to go up. That's already in the consensus. I guess the market will more focus on the core and also the month-over-month print. So if we have something around 0.2% that go align with the idea that it's still softening, and that's good news for the Fed. And so probably the Fed will be able to hold rates in September as we expect.
Laureline, when it comes to Europe, do you want to be pricing in cuts from the ECB in 2024?
Probably, but rather in the second half of 2024. We still need a lot of work on inflation. Core inflation is still above 5%. In terms of employment data, it's still strong. So we know that early indicator on the manufacturing side, for example, is showing a slowdown, but it's not enough. So probably rate cut, yes, but much later than what we could have from the Fed.
And how does the labour market data out of the UK, Laureline, change your view, if at all, around gilt? Maybe it keeps the same view alive for you. We had the wages print coming in, on one measure at least, a little hotter than expected. But in terms of numbers of payrolled employees, that's coming in lower than anticipated. How does all that add up to a gilt strategy?
So I guess it's a bit of a mixed bag, this employment report, that's true. The problem, I would say, with the UK is the elevated inflation environment. So we'll see with the next CPI data next week. But basically, we still need a cooling labor market, and probably we need much more unemployment rate to go up for that to happen, also on the wage growth. And in our view, the BOE is likely still to hike again in September.
Laureline, I cannot remember a fixed income strategist who's not come onto our show and said investment grade US credit is where you want to be adding. Does that window start to close? Is the resilience in the credit market starting to show any signs of weakening? Are you being rewarded still for taking exposure to investment grade credit stateside?
Yeah, that's a good question. It's actually still, to us, a good place to hide versus cash, because it's a way to lock in coupon for longer. It's also a way not to be exposed to too much credit risk, because we still expect this economic slowdown, higher default rate. So to us, it's simply getting an attractive yield pickup, something you haven't seen in years. So to us, it's still a good trade.
Okay, Laureline, Renaud, Châtelain, still a good trade on investment grade credit. The views there on a US recession and risks may be coming through for the first quarter of 2024. From Pictet Wealth Management, the fixed income strategist, thank you. We appreciate your insights. Coming up, ARM's initial public offering is already 10 times oversubscribed. We get the details on what could be the world's largest IPO this year. Are there any flies in the ointment for ARM? Stay with us. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Welcome back. Now, Arm's CEO is pitching investors on a change in strategy while gearing up for what is set to be the biggest IPO of the year. The company wants to also design chips for cloud computing, car electronics, and internet-connected technologies. The IPO could close a day early. It's already said to be oversubscribed by 10 times. For more, let's bring in Alex Webb of Bloomberg Quick Take. Alex, you have raised an eyebrow around the oversubscription lines that are coming through 10 times, possibly 15 times. You're suggesting that maybe it doesn't point to just continued upside for Arm, and that maybe there's some challenges around this IPO.
Well, I mean, look, it's not an absolute shoo-in, right? It's not bad news that they're oversubscribed, clearly, but it doesn't necessarily mean that the IPO is going to be a success on day one, right? That's all really going to come down to the pricing. Like, is the pricing commensurate to a level where the market, after it launches, will want to hold on or keep buying? We don't really know where that pricing exactly is going to land. We've heard that it could be higher than the initial range that was stated. We don't yet have any more clarity on that. Don't forget the sort of multiples that they're looking for, at least on a historic basis, are commensurate to the multiples of NVIDIA, right? But if you look on a forward multiple, it's even higher because, of course, NVIDIA's earnings are going to jump quite considerably. Arm's are not, at least from the current standpoint. They're going to jump a bit, but nowhere near as much as NVIDIA's are in the process of doing. So it requires a little bit of just, cold water maybe, or clear light, I should say, rather than cold water, just to sort of determine actually, is the valuation they're going to go for realistic? Okay, yeah, so a lot to sort of get through in terms of the detail there, see where that one lands. Let's ask about Tesla, because this was a huge upgrade, wasn't it, from Morgan Stanley? Morgan Stanley upgrading their rating on Tesla from 250, or their price target, from $250 to $400 in one go. And this was something to do with the Dojo software, apparently. I mean, look, Adam Jonas is famously a massive Tesla bull and has proven quite right historically, right? Because, of course, Tesla has been on a massive tear. The question is really how... We often talk about the data that Tesla has and the ability to use that data. You would hear historically that actually it's a little bit overstated. Clearly, their self-driving software isn't really there yet. But this is their supercomputer, right? Right. And Morgan Stanley saying, look, we've underestimated the potential revenue upside from Tesla's in-house supercomputer. If that's what he's saying, then I guess you have to... You exhaled at the start of this question. There's loads of stuff that Tesla, or Elon Musk more broadly, is doing when it comes to AI, right? That he has XAI, he has, of course, Neuralink, which is supposed to be partly related to what, AI efforts. Like, how all these things play together and what happens in 5 years' time, they love to talk up products. Some of them do land, right? Some of them are massive successes, a lot of them aren't. Clearly, then Adam Jonas is like, well, this is one that is going to land. He's a believer in the Dojo. What about Apple? Talking of things, whether they land or not, the stress I'm getting from reading about Apple, the launch, is that all about the change of charger. I just can't see past that, Alex. Briefly, what else are we looking for? It's going to be a higher end product, right? It's going to be titanium at the Pro lineup. That will let them charge a higher price. At the moment, you're seeing across the smartphone market a relative stagnation in unit sales. What Apple therefore does is they try to get more money out of the units they do sell. There is less price sensitivity at the very high end, so if you can point towards a few improvements, such as a titanium shell, that might let you to charge a bit more. So the pricing really is the key point. Okay, Alex, thanks very much. Bloomberg's Alex Webb with the latest on all of those tech themes. Very newsy this morning. Now, coming up, the pressure is on for the Bank of England ahead of the meeting next week. We'll dive into the latest UK jobs data. Are there mixed signals in there for the Bank of England? There's certainly a focus on the wages print. This is Bloomberg.
the standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe to 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Nugent Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
This is Markets Today. 30 minutes into your European trading day. Let's get to your top stories. Tech Tuesday, Tesla jumps 10%, driving gains on Wall Street. Apple's new iPhone launches later today. The Bank of England's inflation battle heats up, with wage growth holding at a record high amid a weakening jobs market. And ARM's IPO. The books there are set to close a day early after being oversubscribed by 10 times in what's likely to be this year's biggest listing. So, Tom, a lot of tech scenes to talk about.
Yeah.
They don't land in Europe necessarily.
No, they're not landing.
A very unch feel to the European trading day.
Very unch indeed. They're not lifting. None of those tech stories are lifting or doing anything for European stocks right now. Across the benchmark, you are flat now, having seen gains at the start of the session. Over in Germany, the DAX now off by 0.3%, a drop of 50 points, 15,750, or a little below for the German index. The FTSE 100 here in the UK with a focus around wages and data, but it's less about FTSE 100, isn't it? It's more about the FTSE 250, as Mark Cudmore was flagging for us in terms of the impact in an environment potentially of higher rates for the BOE, but that debate remains live. Still holding above 7,505, so a gain of 9 points for the FTSE 100, a 0.1%. Let's flip it over and have a look at how the sectors are shaking out, with basic resources yesterday leading the charge and technology weighing slightly. It's a very mixed picture, again, in a session where you really get the sense that investors are on hold until they get more clarity from the CPI print out of the US and that ECB decision, of course, on Thursday. We know that is very finely balanced indeed. Energy is down by 0.5%. That's despite the fact that Brent remains just above $90 a barrel. So a little loss coming through for that as a sector. Energy. Industrials down 0.4%. Retail is holding up, gains of close to 0.4%. And the safe haven tilts utilities gaining 0.2%. Travel and leisure also up by 234 points, currently up 0.2%. So that's the picture across these sectors. Again, it's a very mixed picture and still awaiting, it seems, for a catalyst. The UK a bit of an outlier as the FTSE 100 holds above 7,500. Anna.
Okay, so that's the picture across European stocks. Yeah, fairly flat across the stock 600 right now. Let us talk about some of the data we've had out this morning, though, from the UK on the labour market. Interesting story developing. UK wage growth held at a record high in the 3 months to July. Average earnings, excluding bonuses, rose 7.8% from a year earlier. This morning's data is a sign of persistent inflation that will keep pressure on the Bank of England to raise rates again, perhaps. We're joined now by Kate Shoesmith, Deputy CEO of the Recruitment and Employment Federation. Kate, very nice to have you with us. And let me start by jumping off this data that we had out this morning, because it focuses in on a number of key ongoing themes. One of those is the strength in the labour market, in the wages story, and the other is cracks in the labour market. We spoke to a guest earlier on who described this as a sort of stagflation set of data because wages are strong, but employment is looking weaker. What do you make of this data picture, Kate?
So I think it's really important not to draw too many conclusions from this particular set of data. What wages are doing, they're doing exactly what was expected, to be honest. So we've just seen 2 months in a row where wage growth has grown marginally above really high levels of inflation. Now, that's because employers have been having to pay higher wage levels because they're aware of the cost of living crisis affecting their workers. They're also aware of how difficult it's been to recruit because of labour and skill shortages in the overall UK economy. And in many sectors, those labour and skill shortages continue. And that's one of the things that's really important to keep in mind. So yes, we're seeing slight softening of the market. We're seeing unemployment levels rise, employment levels rise marginally. But it's just a case of there are still significant shortages in the market. And actually this wages is just catching up with inflation and it's only just starting to catch up.
Kate, on that top line unemployment number, 4.3%, so it's ahead of where the BOE had forecast by about this time this year. Where are you seeing, in what is otherwise a pretty resilient jobs picture, where are you seeing fragility, Kate? What sectors, what part of this economy, where are you seeing jobs being shifted out and headcount being reduced?
That's the really interesting thing to look at, actually. So in a number of sectors, we've seen that there's been a sustained level of demand, and then you've got areas where there's significant above areas of demand. So health and care, for instance, where we're simply not catching up and there's not enough workers to fill those roles. But actually, the sectors to watch in terms of your question about where we're seeing demand just drop off slightly. Retail's always been one to watch, where we've seen that that's been a really tough year, actually driven by things that perhaps were a bit surprising. Like we had a really wet and damp and bit cold spring. It meant that the summer retail picture was slow to get going, so the workers weren't required in the same volumes. There's been interesting tension in the tech side. So we heard about all of the big tech companies letting go of workers. A lot of those got sucked into the SME market of the tech sector because there was such high demand, given what's been happening in the economy and the demand for online growth. But that tech sector is one that's particularly one to watch at the minute, where you're getting a differential picture across the board.
We still have very low unemployment rates, Kate, versus history, of course. And a lot of people talk about the level of underemployment in the UK economy. And of course, you can tell a positive story about people's choices post-pandemic, that they want to find better work-life balance and perhaps work a little less. Or you can tell a negative story about what that does to the potential for the UK economy. What are your thoughts on this wave of underemployment?
So I think the key thing here is it's a bit of both, isn't it? So the figures to be really interested in is we're actually seeing that youth unemployment has risen again. So that's something that is significant because that's our future workforce. That's a talent pipeline we need to be really clear on. We still know that we have a significant number of people who have made an active choice to not participate in the workforce. As you say, it can be seen as the positive of the post-pandemic phase of life, where people have decided to weigh up that work-life balance. Interestingly, the temporary workforce figures have held strong. So people are both opting to work that way to get a more flexible type of work, but also businesses are choosing that whilst there is this economic uncertainty out there. And I think the key thing here is the economic inactivity levels. They're still record high levels, and the number of people on long-term sick leave who cannot work, that's the key thing that's really holding us back. And when I talk about labour and skill shortages, if we don't fix things like the NHS waiting list, we can't have a hope of bringing these people back into the workforce and getting to grips with the growth agenda that we really need to be seeing in the UK right now.
You're right. I mean, that number is shocking. On some estimates, 2.5 million people in the UK long-term sick. So for you, the answer then is fixing the NHS. Is there anything else you're hearing from employers around what is needed to get those workers back into the labour market?
Some of these people, they're so far away from the jobs market, and that's something that's got to be a combined effort across government. We can't just expect the NHS to fix waiting lists on their own. There's got to be the investment there. There's got to be a sense of actually think about the labour skills that are needed. Why can't we do more about some of this, the NHS waiting lists? If there's not enough staff working in the sector, and that they've actually been reducing that capacity because people have been leaving because of burnout, then we don't have a hope of fixing it. So these things are all intertwined. But also there is a duty of thinking across employers as well as on the government responsibility. What can we do? How can we provide more flexible working opportunities? How can we ensure that work is fit for purpose and that people can bring different needs to the workplace? And thinking about things like what are we doing to encourage disabled people to enter the workforce and stay in employment? Those are all things that employers can do, but we do need that help with the overarching structure from government, because some of these issues need to be funded in terms of thinking about what's the employability gap that people have, how do they get the skills in the right place, how do we ensure that they're getting training that means that they're ready for work.
Kate, what do we make of the latest signs around labour market hoarding? I mean, some of the figures this morning around employment might suggest that businesses are hoarding less now, and that would be an early sign of these cracks in the labour market coming through. What do you see on that dynamic?
One of the things that we do at the REC is we've been doing a report called Report on Jobs. We do it at S&P Global for the last 25 years. We've definitely seen a softening, if you like, of the labour market over the last few months. So, but you're comparing it against 2022, where there were record high demand for workers in pretty much every sector and every area of the UK economy. And so throughout 2023, we've seen that softening, and now we're seeing candidate availability. So that's people looking for work, actively looking for work, going up marginally and slowly as we've gone through 2023. And that is one of the things that recruiters are reporting to us, is that's because redundancy programs are starting in some sectors. Now, as I say, some of those people are being sucked back into the labour market almost automatically. So if you've got the right skills and in the right area, then there are jobs still available. But we are seeing that gradual softening in the labour market now.
Okay, Kate Shoesmith, with some really interesting context and added value around what we're seeing in terms of the changes around this UK labour market. Thank you, Kate Shoesmith, Deputy CEO of the Recruitment and Employment Confederation. Coming up, Campari shares tank after news that the drink maker's CEO has decided to step down by April of next year. We bring you the context. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
is Bloomberg Markets today. We're 43 minutes into a European equity market session that looks, well, a little more positive than it did, up by 0.2% on the stock 600. The FTSE getting the best of those gains. The DAX underperforms a little. Let's check in on the individual stocks that are moving this morning. Joe Easton joins us from our equities team. Joe, what have you got?
So Smurfit Kappa has recovered very slightly, but still down around 8% as they announced this deal with Westrock in the US. Now, I can't really remember a deal being taken as badly as this has, with that stock now down 15% since the talks were announced around a week ago. Now, fortunately, the guys at Jefferies have done some calculations, so I don't have to, and they are saying that because the shareholders in the US will get one Smurfit share and $5. That calculates as a 36% premium, which is much more than they think this deal should be worth. So that is why investors aren't liking that deal, according to Jefferies at the moment. Now, Feathertree also reducing some of those losses, was down 8% around 10 minutes ago, now down only 1%. They, of course, did cut their guidance before the open. They are saying it's the UK that has driven that decline. The US looking pretty strong. I'm running out of puns on that one, so I'll keep the jokes on ice for now. But another drink stock that's in focus, this one dropping. We're seeing a straight line down in shares of Campari. I've just been told in my ear by the producer, thank you, Abby, that stock has now been halted. Limit down 4.7%. They've announced that the CEO is stepping down. He came into the job around 4 years ago, but he's been at the company 16 years. Not really sure why they announced that during the market open instead of pre-market. It might have saved some volatility on that one. But I'm sure the leaving drinks are going to be pretty good. Anyway, in terms of Airbus, this one is lower. We mentioned Pratt & Whitney from the US. That was a big story in the US market. And there's a story on the terminal saying that hundreds of Airbus planes will now be grounded because of that news. They won't be able to fly. These are the narrow-body, short-haul jets that Airbus uses engines from Raytheon, and that stock is falling around 1% today. In terms of the companies that are gaining, it is very much driven by ratings changes in terms of the top two. So HelloFresh, the best performer on the stock 600 today. JP Morgan opens a positive catalyst watch. They were actually underweight that stock just a couple of months ago, so they've double upgraded in the space of 2 months, and that stock's trading at a year high as JPM says the company is doing better in the US now. Another one getting a positive rating is Watches of Switzerland. Goldman Sachs recommends buying Watches of Switzerland shares. They say that although Rolex will start selling its own watches via Boucherie that it bought a few weeks ago, they think Watches of Switzerland will still have a chunk of the Rolex market, and that one is actually, well, ticking higher, you could say, I guess, with that one, if we're keeping the puns running. AstraZeneca gaining after the biggest drop in 2 months yesterday. They fell after it announced some weak lung cancer drug data, according to analysts. The analyst said the safety data wasn't as strong as expected, and that one was down 4%, but coming up a bit on the FTSE 100 today. And then finally, H&M is a read across over from AB Foods. Primark getting a boost, the big rival. Primark, AB Foods up around 1%, but H&M gaining even more, up around 2% in Stockholm.
Joe, thank you. Thanks for the check on the market moves. So from our equities team, Joe Easton with the latest on those movers, Campari and all the rest. Let us get to some of the other top stories crossing the Bloomberg terminal this morning. Now, Morocco says it expects the IMF and World Bank annual meetings in Marrakesh next month to go ahead as planned. The government, meanwhile, has pledged to help survivors of Friday's earthquake that killed more than 2,700 people, including financial assistance for reconstructing homes and schools.
Okay, the luxury armoured train carrying North Korean leader Kim Jong-un has crossed into Russia ahead of his visit with President Vladimir Putin. State media in North Korea and Russia said the two leaders would meet, but no official schedule has been released. The US says the talks will focus on supplying weapons for Moscow's war on Ukraine.
The US has cleared the way for $6 billion in oil proceeds to be returned to Iran and agreed to release 5 Iranians. The moves come as part of a secretly negotiated deal that will clear the way for 5 American citizens detained in Iran to return home. Secretary of State Anthony Blinken says the $6 billion will be held in restricted accounts where it will be available, quote, only for humanitarian trade. A really fascinating story. Clearly, this is about prisoners, but it's also about oil money and where that goes. And it really just takes us back to a building story that we've been tracking since August. Our colleagues getting some commentary from US officials acknowledging they are taking a lighter touch when it comes to the sanctions that have been put on those oil flows with regards to Iran. So that's really fascinating. And Tehran's production actually at its highest levels now since these sanctions were first put in place 5 years ago.
Yeah, and at a decade high, I believe, in terms of their sales to China, and particularly on China. It seems like the US is prepared to turn a blind eye. This has been happening somewhat in the background, very, very sensitive talks. But yes, there's the importance of the prisoner swap, but arguably for the global markets, at least more importantly, the fact that these discussions have been going on, more Iranian oil being released onto the markets. Of course, Biden focused on gasoline prices. And so it's a fascinating dynamic in terms of geopolitics and these energy markets. Briefly checking in on oil, Brent currently at $90 a barrel, just getting 0.3%. There is a question mark as to how much more Iran can pump onto the advantage, despite the fact that these sanctions are being softened, or at least the imposition of these sanctions and the enforcement of these sanctions is being softened.
Exactly. And some voices speaking to Bloomberg suggesting that any return to the lapsed nuclear agreement is distant. So it's not like we're joining all of those dots right now, but at least some of the dots being joined. And this has the hope, I suppose, in Washington is this puts downward pressure on oil prices, which is not what we're seeing right now.
Okay, coming up, the UK posts record wage growth again, piling more pressure on the BOE. We're going to discuss what it means for the central bank's next rate decision later this month. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food. It gives us jobs. It gives us, of course, oxygen. We're taking too many fish out. We're polluting it. We're making it warmer. And only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Welcome back. Happy Tuesday. This is Markets Today. We are, 52 minutes into your trading day. Just checking on your markets. Just seeing gains of a little under 0.2% across European markets. And across your sectors, top of the list, telecoms gaining 0.7%. Bottom of the list, energy off by 0.5%. Let's talk about what's happening in these markets with a particular focus on the wage data, the labour data out of the UK. And let's bring in Venram from our M Live team, always pertinent and acute in terms of his views on these central banks, the implications of some of this data. Ven, your take then, does it move the dial for the Bank of England?
Morning, Tom. I do think that this data is going to persuade the Bank of England to stay hawkish. And definitely, I think that the markets are underpricing the risk that the Bank of England will go again next week. I think the markets are pricing an 80% chance. I see it more like a 95, 98% chance that they will go. The remainder of the 5% that I'm giving the benefit of the doubt is for the CPI data that's due next week before the BOE meets. I think that the wage data shows that there is still evident entrenched price pressures in the economy, and the BOE won't be able to stop raising rates anytime soon. We did get a bit of a tick higher in the unemployment rate, but I don't think those are yet at levels that would stop the BOE from growing.
And so what do you make of the fact we've seen a slight drop? I mean, the pound hasn't moved all that far then on this, and it spiked up, then down, then flat, now down again, a couple of tenths of a percent. So not big moves, but it seems as if, was this all priced in, do you think? Or is the market, as you say, underestimating the chances of a hike?
I think that the markets are also thinking, in terms of the pound, the markets are thinking, look, how far has the BOE got to go from here? If we get another 25 basis point next week, which I think we will, the markets are thinking maybe perhaps not too much beyond there. And that's why the pound has been held back a bit. But I do think that the pound still has got tailwinds. That'll come probably from the BOE realizing later on that the economy is still strong, still resilient enough to allow it to go to 575. The markets are factoring in another 38 basis points of tightening in this cycle. So I do think that that will come about. The economy, at the moment, the markets are too fixated on the weakness in the economy, which I don't think is as material as the markets seem to think.
Okay, interesting. And seeing yields moving, you know, they are moving in terms of gilts and UK debt. 5 basis points at the front end at 5.03. Then, do we have to? If you're right, and we get another hike coming through from the Bank of England, you say there is a little bit of a caveat around the CPI data out later this week. If there is another hike, then do we have to actually bring forward the cuts that may be coming through from the Bank of England next year?
I think that the Bank of England will be one of the last central banks to start cutting rates, definitely later than the Fed, because I do think that, you know, the inflation upsurge has been so strong, and the momentum for inflation, the second round effects of inflation are so strong and so deeply embedded into the UK economy. Even if they wanted to accommodate a materially weaker UK economy down the line, I don't think they quite have room to do that. And their policy rates, real policy rates, even now, are negative, which means that there is simply no room for the Bank of England to accommodate the economy by starting to cut rates.
You don't think there's a risk then, that the economy takes a dive as a result of all of the mortgage refinancing that has to happen over the next 6 months, 12 months?
I do think that there is going to be some material economic weakness down the line. There is no question about it. It's a question of when that happens. I don't think we are at that point yet. But even if it comes, I do think that, you know, the UK economy is going to be resilient enough to withstand some of those. There is going to be weakness in the economy, but I don't know if it's going to be so strong as to persuade the Bank of England to start cutting rates.
Okay, Ben Ram from our Markets Live team with the analysis there, the take, the interpretation of that wage data and what it means for rate expectations here in the UK. And just briefly checking on these European markets then, very modest gains of about 1/10%.
Yeah, by 0.4% on the FTSE 100, underperforming over in Germany. So some variety, some variation around the theme here in Europe. US futures looking flatter, more negative actually, down on the Nasdaq. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. ARM's IPO book is set to close a day early after being oversubscribed by 10 times. It's likely to be the year's biggest listing. Tech Tuesday, Tesla drives gains on Wall Street after an analyst call. Apple is set to launch a new iPhone. Plus, UK wage growth remains at a record high, putting more pressure on the Bank of England to raise rates again. So let's take a look at the European markets map. A lot of the focus, of course, is on what we heard not only from, well, the big take is basically the strength of headline pay growth and the latest jobs data is definitely keeping the Bank of England on course to hike again in September. Now, the picture across the board, certainly when it comes to the FTSE, we're seeing a little bit of gains across the board, a bit more downside pressure, of course, the CAC 40 and the DAX. So let's look at sterling. If you look at Bloomberg Economics and their very latest, the base case, they say, is whether this will be the last rate hike of the cycle. They're also seeing further signs of softening price pressures and a weakening economy. And so they basically say that, look, this coupled with recent communication from key policymakers means that there is a downside risk to their view. The other thing we're looking out for is, of course, Apple. Now, the new iPhone launches today. Keep an eye on the world's most valuable company. This is what the Apple stock price has been doing 1 year on. And then finally, the ARM IPO, I have to say, is without a doubt the story of the week. The IPO is ramping up. It has been a slow year, but there seems to be a lot of appetite. And so we'll keep a very close eye on how much it's been oversubscribed, if that tenfold figure does get confirmed, and what that means for final pricing. Now, that leads us, of course, to our big number. Bloomberg has learned that ARM's bankers are planning to stop taking orders for its IPO by this afternoon. And that's as the offering is already 10 times oversubscribed. Now, pricing is still expected tomorrow, trading on Thursday. It may even end up being 15 times oversubscribed. So let's bring in Bloomberg's Joe Easton. Joe, there's a lot going on. I don't know whether this is the pricing, right, that they just got a little bit wrong, and so it looks very appealing. So it's always better to underpromise, overdeliver, or whether this is a story about technology.
Yeah, I think the numbers that you showed there, obviously, it seems to have quite high demand. The question is where the demand comes from. If the demand came from the retail market, then they probably have a lower threshold for pain if the stock does start selling off in the first few days. And we've seen in tech IPOs in particular, the first few days often don't look pretty. In terms of the pricing, we'll find out how much they've left on the table for investors in terms of how much they want for that company. But in terms of the demand, you'd have to question where that's coming from, in my opinion.
Yeah, it's a good question. So joining us for a look at the markets and the global economy is also Invesco's head of multi-asset, Georgina Taylor. Georgina, when you look at ARM, I don't know whether this is a little bit symptomatic of where cash needs to go to or what the read across this is.
Yeah, I think, look, it's a single stock, so I'm not quite so focused on that. But I think absolutely in terms of where people want to deploy cash, and so it'll be very interesting to see how this plays out and whether the sector themes continue that we've seen for such a long period of time. So yeah, a bit more kind of in the detail for me, but absolutely it'll be interesting to see how that plays out.
Yeah, and I know you don't look at a single stock. So I mean, is it symptomatic or actually money trying to find places, or is it something that you look at kind of from afar just because of the nature of what you do?
Yeah, I mean, I think, we look from afar, but what is interesting is how people are deploying cash in this type of market environment, and also what people look for in terms of returns, because where cash levels or cash rates are in terms of finding those opportunities. So yeah, looking a little bit from afar, but yeah, absolutely, I think it's symptomatic of where we are right now in markets.
Joe, what can you tell us about tech valuations in general? So we had Tesla, that got a big boost. Today, we're also expecting Apple.
Well, I think the chart that you showed on the screen with the Apple 1 year, obviously that big rally, and then over the past week there's been a lot of, well, quite negative comments around Apple given the China issues. I saw Citi analysts were quite bearish on that one, but I think where it's trading at the moment, there's obviously a lot of gains still in that stock, so I don't think there's too much negativity at the moment, I would say.
So you do our stocks to watch every day. Is
Yeah.
there a pattern to the stocks that are flying off the shelf? Is it margin pressures? Is it the ability to go up in price?
Yeah, I think that we're still seeing a lot of shares that had the sort of post-pandemic sell-off now coming back up, and I still think there's still a lot of trades there. Good example, I'm going stock specific again, but HelloFresh today, JP Morgan recommending buying that one. That's the best performer in Europe today. So I think that we saw a normalization after the COVID issues, and now a lot of those stocks are trading on low valuations, and those tend to be the ones that are getting a boost at the moment.
And Georgina, where do you see the most ongoing risks for equities overall?
I think it's policy still. I think we keep reverting back to the old playbook of as soon as we hit peak rates, rates will come down. And I think we've got a lot of evidence now that, well, we probably haven't hit peak rates yet, but they may not come down quickly. And I think, from an equity market perspective, that poses a huge risk, not only from valuation, but also how much that chokes off growth. And we haven't really seen huge evidence of that yet. And I think earnings have kind of been okay. But I think because it's carried on so long, I think the market is interpreting that as, well, we've avoided it. We've come through it, and we've come through the pain, and we've come out the other side. And I think it might just be a little bit too early to call that.
But so do you worry about consumer spending or consumer behavior and savings, or do you worry more about refinancing and that companies in general have?
Yeah, I mean, I think it comes from both sides. So I think from a consumer perspective, that buffer is getting less in terms of that savings buffer that was built up during the pandemic. I think from a corporate perspective, they've got away with it so far. The refinancing hasn't kicked in yet, so that's from next year onwards. So we're certainly focused on stronger balance sheet companies, even though it feels, again, people want a price coming out of that. I think it's still the place to be because that refinancing risk still comes ahead over the next 2 years.
And you prefer Germany versus France. Is that, again, on valuations? Because they're also a lot more exposed to the energy complex.
Yeah, I think you've got this manufacturing versus consumer theme. I think that the luxury goods stocks have shown us a hint of what can happen when things start to turn and people get worried about China. I think Germany and France are two core markets in Europe, but their performance differential has been huge. So we think there'll be a bit of reversal of that if we want some self-sustaining growth to come through from investment, and the DAX will benefit a little more from that versus France.
Do you see, I mean, again, you look at some of these stocks day in, day out. Is there more stress in the companies that are more exposed to energy, for example?
Yeah, energy is an interesting one. Obviously, miners has been the big commodity story at the moment. Those stocks are trading at very good multiples now. I'm actually seeing a lot of people becoming more positive, think they've sold off too much. Energy is more difficult. I think the oil forecasts are mostly bearish, but I think the big thing with energy is obviously the dividends and buybacks still pretty strong. So energy is not so much of a weak spot. I'd say it's miners is where there might even be an opportunity, I think, in terms of some analysts.
To you both, but Joe, I mean, have we seen companies with a lot of distress calls? And if not, could it come in the fourth quarter?
Well, I mean, that's something that I've been looking at for a long time, is how much of in terms of interest rate rises, how much of that has been put through into analyst estimates on a number of sectors. For example, the one that got a lot of focus was real estate, but there's probably a lot of sectors that hasn't necessarily been put through analyst estimates in some parts, I'd say, and that could then be quite negative.
And Georgina, you also have a pretty balanced risk exposure between credit and equities. Does that change as we get into the winter months?
Yeah, I mean, I think that, look, we'd still say there's a bit more risk sitting in the equity space. I mean, I think what's quite interesting from a leverage perspective is looking down the market cap spectrum a little bit, look towards those smaller and mid-cap companies where they're more reliant on, say, bank lending, and so therefore they're seeing those higher borrowing costs. So, yeah, we're still a bit balanced. We think it's too early to make a big call in terms of risk on, so it's really trying to get a little bit of balance between a bit of high yield, a bit of equity, but actually looking more at relative value opportunities in this type of environment.
Georgina, what do you do with China? So Country Gardens are rebounding as there's been this bond extension, right? I'm not sure. Every 2 days we have good news, and then the 2 days afterwards we have bad news. Yeah. So how does that figure out in your complex portfolio exposure?
I think what's interesting about China is we all got excited about China at the end of last year, coming into this year. It was on its own path. It was doing something different from a policy perspective. I think, look, all eyes on China a little bit in terms of that impetus to global growth, but it's not going to be the big decisive turning point for markets that everyone's been waiting for. So I think the drip feed is there. I think what's interesting is the propping up of property, whereas they actually wanted to focus on a more balanced view of growth. So we're watching for that to make sure they stick with that view of where they need to point and press policy, so get some of that more self-sustaining investment, and then you get the ripple effect to the rest of the world, and that's more important for global equities.
And Georgina, do you think the ECB holds fire?
I think they should, but I think, look, even with the data today for the UK, I think the pressure's on for them to keep going, but I think on balance they pause for now.
Okay, thank you both. Joe Easton there and Georgina Taylor from Invesco, where she's head of multi-asset, stays with us. Coming up, signs of cooling. UK unemployment hits the highest level since 2021. Wage growth remains elevated. We'll focus on the UK next, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer, Wednesday on Bloomberg.
If we don't change course,
we are going to see taxes going up. And how do you change course? You have to increase growth. And you'll be hearing a lot from me in the months ahead about how we increase our growth levels.
Well, that was the UK Chancellor of the Exchequer, Jeremy Hunt. Now, UK wage growth held at a record in 3 months to July. Average earnings, excluding bonuses, 7.8% higher than a year earlier. But the hot labour market is showing signs of cooling, with unemployment reaching the highest level since 2021. Well, here with me, Georgina Taylor, head of multi-asset of Invesco, and Anna Andrade from Bloomberg Economics team. So thank you both for either sticking around or joining us. Anna, I mean, is this like a perfect storm for Governor Bailey? If you look at the rapid pay growth, does it just mean that they need to keep on hiking?
Hi, morning. So yeah, I think so. I mean, this today's data was overall very strong. Just because we didn't get the surprise in wage growth as we've been, used to over the past months, doesn't mean that we should be, or the BOE should be, any less concerned about the level of wage growth, which is still in the private sector is still running at above 8%. The labor market is true that it's cooling, but again, what we saw in today's data is that it's cooling at a very, very gradual pace. So that's unlikely to kind of shift the dial at the MPC. If you're looking for dovish or like a weak data detail, then the softer pace of underlying wage growth, so month on month on a 3-month on 3-month basis, annualized basis, that has kind of turned. But again, it's just one data point, and I don't think it will be, enough to change the BOE's thinking.
But so Anna, what's the danger actually of for the BOE right now? Did they over tighten or not tighten enough?
I think, there's always, as we get to this kind of late stage of the cycle, that will be kind of the hard, difficult question to answer. But I think from what we heard from them is that they're more concerned about doing too little than doing too much. It's true that we've been hearing some, dovish communication from the, Hugh Pill and Andrew Bailey as well in recent weeks, and they kind of tend to focus more on fears of risk of over-tightening and of being near the top. But again, if you look within, within the lines, they also say that they want to take levels to a sufficiently restrictive level, and that they want to see the job through. So I still think that they will prefer to do a little bit more than less.
Okay, Georgina, what does this mean for UK assets?
It's difficult because I think we'd probably be slightly more in the camp that for Bank of England credibility, they need to keep going. They have their inflation mandate. They have to stick with that. And again, as you've said, this one data point does not mean that it's decided either way. For UK assets, though, I think there was an immediate move in the sterling to say, well, does this mean interest rate differentials support the pound? I think we're heading into policy mistake territory, potentially, because we've got such a unique inflation environment in the UK that I don't think there's that kind of linear relationship between growth and inflation. So I think for us, probably leads to a weaker pound at some point because we start factoring in weaker growth, not just higher interest rates. But I think the UK market is not the UK economy. And I think there are sector trends like energy we mentioned earlier that could support UK large caps. Maybe mid caps is where the risks still lie for the UK.
And I guess, you argue that basically regular pay growth in the private sector is the most important, detail in this jobs data. Have they lost control? I mean, it kind of feels like it has a mind of its own. It's, fell slightly, it's still 8%. How many more rate hikes do they need to do to try and get that under control?
Well, I think there's two things. I think there's definitely, you're definitely right that, the level of wage growth is too high for them kind of the optics to engineer a pause are not good. You cannot really stop the hiking cycle when wage growth is at 8%. But then again, there's two moving pieces that are kind of, let's say, more benign for the outlook for wage growth, and one is inflation expectations. So inflation expectations have been falling, and inflation will fall, and in October we'll get another big drop based on energy. So as inflation expectations adjust downwards, so will wage growth. And then the second piece is that the BOE has delivered, it started its hiking cycle in December 2021. We've seen nearly half of it being passed through, but there's still half of it to come. So, at some point, it doesn't mean that they will continue hiking forever. At some point, they will need to shift, and focus on the level of the current, of the interest rates and how much tightening is still to pass to the economy.
So do you see any value in small caps? I mean, you're saying, of course, rightly say, if you look at the market, it's not the Bloomberg, the UK economy, but also there's a huge shift or a huge difference between small caps and the big ones.
I think, look, in aggregate, I think the mid and small caps still look a little bit vulnerable. It links in with the leverage point, the pass-through, the demand that might get impacted. I think from a single stocks perspective, there'll be some great opportunities in terms of really looking at where we're linking into the right trends that are coming through in the UK. But I think from a kind of asset class perspective, just waiting and seeing in terms of how, again, the lagged effects of this tighter rate cycle that we've seen so far and how that feeds through.
So do you go for sector-wise, or is it exposure maybe to other parts of the world that are also stronger?
Yeah, I mean, I think, look, in the UK, I think go large cap. I think large versus mid is still an opportunity, because if we get that weaker sterling feeding through, some of the sector trends we've talked about support, I think still probably the larger cap stocks over the mid and small. And then I think you look elsewhere. Look, the US still looks expensive in all of this. They don't get so much help in terms of moves in currencies. So a little bit of value outside of the US coming through, and again, balancing that with credit as we talked about earlier.
Is there anything else that you're looking for in the next couple of days ahead of that big decision on the 21st?
I mean, we'll have CPI data next week, although we don't expect the trends to change meaningfully. You know, the picture there has been, we actually expect headline inflation to tick up a bit based on fuel, but services inflation surprised the BOE in the last release, and we expect it to remain, above what the BOE had projected. So, the story of strong cost pressure in the economy is not going to change, with the next data release.
Great. Thank you both for joining us. Georgina Taylor, the head of multi-assets of Invesco, and Anna Andrade from Bloomberg Economics. Now, coming up, Jamie Dimon is not happy with the bank's higher capital requirements. He did not mince his words. We'll bring you part of that conversation with the JP Morgan chief executive. That's next, and this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
the Federal Reserve should have a little humility. They're the ones who told the world rates aren't going up. And it wasn't the Federal Reserve in general, it was each one of them independently. In fact, it was each central bank. So if I were them, I'd have a little more humility over stuff like this.
Well, JP Morgan's Jamie Dimon there taking aim at regulators over higher capital requirements. Now, let's take a look at some of the corporate news now, and shares in packing company WestRock up in pre-market trading. That's after agreeing to combine with Smurfit Kappa. Now, the $11.2 billion deal creates an industry powerhouse domiciled in Ireland. Now, the new group will be called Smurfit WestRock. The deal will create a packaging giant that provides everything from corrugated storage boxes to beer carriers and e-commerce shipping materials. Now, Oracle shares are slumping in pre-market trade after a slowdown in quarterly cloud sales growth. The cloud's unit revenue jumped by 30%. That was down from the previous quarter's 54% gain. Oracle is also focused on expanding its cloud infrastructure business to better compete with the likes of Amazon, Microsoft, and Alphabet. And the Ryanair chief executive has slammed Italy's proposed cap on airfares. Michael O'Leary told Bloomberg the price decree is, quote, illegal and completely unenforceable. Now, he says the Italian government has also failed to explain how it works. O'Leary said the airline would consider thinning out its domestic flight offering in Italy should the government hold on to the price cap and instead offer more international flights into Sardinia and Sicily. Then the other thing we're watching out for is Bitcoin briefly dropping below $25,000 for the first time in 3 months. There's speculation that FTX could begin sales of digital assets through its bankruptcy process, weighed on other cryptocurrencies. Now, the largest digital currency slumped as much as 3.3% yesterday. And then U.S. cable company Charter Communications is set to offer Disney's flagship streaming service at no additional cost to its subscribers. Now, America's second largest cable provider will include Disney Plus in a $60 a month Spectrum TV Select offering. Sources say Charter will pay Disney a wholesale price for the service. Now, pound actually extending some of the gains after we had the labor market data providing respite for Bank of England policymakers, but it does signal some relief for Britons who saw the real wage growth in 16 months. So Britain's red-hot labor market is showing signs of cooling as unemployment hit the highest level since 2021. The number in work declined and private sector wage growth also eased. Coming up, we're joined by Ralph Schlostein. He's chairman emeritus of Evercore. As chief economist, and major banks see the U.S. dodging a recession. We'll discuss that and much more. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So That's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
IPO book is set to close a day early in what looks likely to be the year's biggest listing. Tech Tuesday, Tesla drives gains on Wall Street after an analyst call. Apple set to launch a new iPhone. Plus, UK wage growth remains at a record high, putting more pressure on the Bank of England to raise rates again. Well, good morning, everyone, and welcome to The Pulse. I'm Francie Lacqua here in London. Now, the Federal Reserve is done raising interest rates and will likely cut them in 2024. That's the view of chief economists at some of America's largest banks. While the U.S. might dodge a recession, economic growth looks set to slow over the coming quarters. Well, Ralph Schwartzstein, Chairman Emeritus of Evercore, joins us now. Ralph, it's so good to speak to you. We've been trying to set up this interview for quite some time because I want to understand from your perspective what is going on in a lot of the companies. Interest rates have gone up quite significantly.
Right.
Can the U.S. really dodge a recession?
We can. I don't think it's a certainty because what we really don't know is what will be the effect going forward on the real economy of the large increases in interest rates we've had already. Whether the Fed raises again another 25 basis points, I think, is really not a big deal, one way or the other for the economy. The real question is, what will be the effect over the next 6 to 12 months of the 500 basis points of raising that we've already had?
Why is it taking so long? So usually it translates, what, like 12, 18 months down the line?
Yeah, but if you think about it, we started raising last August, September, July. So we're really in the early part of that 12 to 18 month period of time. And the larger increases have really occurred 6 to 9 months ago. So, you know, there's another big factor affecting monetary policy and interest rates and their effect on the economy is that we had this massive stimulus in response to COVID, and that's been rolling through the economy, and it's still being spent. So that's probably mitigated somewhat the impact of the Fed tightening.
So is there a risk that the Fed actually over-tightens and then have to quickly reverse and cut?
I don't. I think the risks now are pretty symmetric. I've been saying for the last 15 months that the risks of overshooting were much higher than the risks of undershooting. And the reason I said that is that the Fed was legitimately and appropriately spooked by the fact that they had overused the word transitory 15 months ago. And so they kind of lost their bona fides in fighting inflation. So that's a terrible thing for a central bank. So they had to do everything possible to convince the markets and participants in the economy that they were serious about fighting inflation. I think we're now seeing real progress on fighting inflation. Inflation is coming down. Labor markets are weakening a little bit. So now I think the risks of over-tightening and under-tightening are asymmetric.
But inflation is coming down, and it wasn't only the Fed, right? The ECB was also saying the same, that it was transitory. Is there a risk that actually inflation's coming down on its own? And so coupled with those interest rate rises, we're going to see, if not a recession, certainly a lot of companies go bust.
I don't know about companies going bust. Well, there's a fair amount of leverage, and rates have gone up a lot. So highly levered companies clearly are vulnerable. Going bust, what normally happens is they restructure, they reduce their debt, the equity holders sacrifice. So I don't think we're going to see anything approaching what happened in 2008. I'm not worried about that. Could we have a mild recession? I think the chances of that are 50-50, 60-40 maybe against. I'm not as positive as other observers of the markets that we're going to escape recession.
Ralph, when you look at also the unwinding of QT, like what's most perplexing actually in all of this? I don't know whether it's market behavior or it just feels like we're not sure where we are in the cycle, and we're not really sure what the economy looks like. I think we've gone from like soft landing to hard landing to no landing to soft landing.
Yes. Well, this is, I've said this before, the most uncertain period of time about the economy that I can remember in my 40-plus years in finance. Not the most scary. No. 2008 was scary. COVID was scary. I don't think we're going to have any kind of a catastrophic event. But, when does the Fed stop tightening? Where do they stop? What effect does that have on the economy? Do we have a recession? There's a phenomenon that I've seen, which I've never seen before. When I meet with CEOs of companies, every one of them says, my company's doing great, but the economy's not doing that well, and so-and-so's company over there isn't really doing that well. I've never seen that. And that's indicative of a high level of uncertainty. Now, with respect to quantitative tightening, so far we've seen a pretty material shrinkage of the Fed balance sheet, and longer rates have gone up, but not in a uneven or scary way. I do worry at some point with the Fed coming out of the market as a buyer, and the dollar at some point weakening, that it becomes a little bit harder to finance the very large deficits that we have, and if that happens, long rates will go up.
So it's interesting what you say about chief executives. What does that mean they do with investment? So at the moment, they're still hiring. We're certainly not letting anyone go.
Yeah, they're hiring and they're investing in their own business. The implication, I think, is that the business of Evercore, mergers and acquisitions, has been slow over the first 6 months. There's lots of things that almost every CEO wants to do strategically. I would say today they're more actively discussing those things than they were 6 months ago, when there was more a deer in the headlights view about the economy. But we're still not at the point where people are prepared to take big actions on the scale that they did in 2021.
So does that mean underinvestment, or does it mean?
I think we're still seeing pretty significant investment in people's own businesses, and employment is still growing. And I think there is a phenomenon because of the recent challenges in hiring people, the inequality between job openings and people looking for jobs. Companies are clinging a little bit more cautiously to their employees, particularly their high-quality ones, than they might in another uncertain economic period.
Ralph, M&A is a funny thing because you do it in good times and bad times. Yes. You probably do it for the good reasons or the right reasons in good times because you want to grow and get better and get into new market share. You do it, I don't know if it's desperation or to help someone out in bad times. Is there a danger that we'll have a pickup in M&A activity for the wrong reasons?
I don't think so. I think the days of CEOs doing transactions to mask problems in their own business are pretty much behind us. The performance of those transactions has been so bad from a stock point of view that both CEOs and corporate boards are a lot more cautious about transformational transactions. And then, of course, you have the regulatory oversight as well, which the whole antitrust is a little bit more aggressive than it was historically as well.
And do you think when there is a pickup in deals, is it mainly domestic, or are there also going to be cross-border?
Well, I think the whole world is becoming a little bit more onshoring, nearshoring. So the transactions that were designed to dramatically expand a company geographically probably are going to be a smaller share of activity over the next few years than they have been over the last decade.
Ralph Schlosstein, thank you so much for joining us. That was the Chairman Emeritus of Evercore. Now, coming up, Morocco says it needs to rebuild at least 30,000 homes and hundreds of schools, hospitals, and other infrastructure after its deadly quake. We'll discuss that just ahead, and this is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Now, Morocco's prime minister has pledged to help survivors of the earthquake that has killed more than 2,700 people. For more on this, we're joined by Bloomberg's Abir Abu Amar in Dubai. Abir, so talk us through this aid, as well as the IMF and World Bank meetings next month.
Good morning, Francine. So yes, the Prime Minister came out and said that Morocco will need to build over 30,000 houses, as houses in villages close to Marrakesh have been completely destroyed. This aid also includes 500 schools, hospitals, roads, and multiple other infrastructure. The death toll, unfortunately, has surpassed 2,800 people, with thousands more that are critically injured. The Prime Minister's pledge comes as rescue teams, including from overseas. We know that Morocco has sought help from at least 4 countries, including the UAE, Qatar, UK, and Spain. So they want to reach those remote areas where anger has really been brewing over the government's, well, not lack of action, but the action hasn't been as momentous as people have been expected. And then as for the IMF meetings that are supposed to take place in the mid of October next month, we know from sources on the ground, our reporter on the ground who's interviewing people and talking to people, quoted one of the Moroccan officials who said that the show will go on. Those IMF meetings are still set to happen, and the decision on whether to go forward with this event is really up to the Moroccan government's hands. We know that the IMF and the World Bank have stuck to their statements and told us, listen, our sole focus right now is on the people. No further statements have been given, and this wouldn't be the first time that the IMF holds meetings amid a catastrophe. We know that in 2018 in Bali, after the tsunami that killed over 4,000 people, the IMF continued with the annual meetings with then Director Christine Lagarde touring the site of the destruction.
Abir, thank you so much for the update. Abir Abu Omar in Dubai. Now, North Korean leader Kim Jong-un has arrived in Russia on his luxury armored train for a rare summit with the Russian President Vladimir Putin. The U.S. believes the talks will focus on supplying weapons for Moscow's war on Ukraine. Now, for more on all of this, we're joined by Bloomberg's Sang-Min Cha. So, Sang-Min, Kim has arrived. Where is he headed to next, and when is the summit with Putin?
That's right. He has arrived in Russia. We know that he just got out of his luxury armored train. He was welcomed with a ceremony at the Kazan station. From Kazan to Vladivostok is just 150 kilometers away, so it's actually a short trip. But we don't know if he's really headed there, and this is pretty normal. It was actually the information that's not being shared. It was pretty common, and it's even worse during his father's times. So he has some options in the Far East region of the region or the area, but he will be around the region where the EEF or the Eastern Economic Forum is happening right now. Putin just made a speech in the plenary session there, and we know that the two leaders are going to meet sometime this week, but Kremlin had said that it's not going to be during the EEF, so we're thinking maybe it would be tomorrow or the day after. This date is just not set yet, but the two will be discussing a lot of things, and this is quite of a landmark summit it will be, as it is happening for the first time in 4 years again.
So what does Putin want from Kim, and what does Kim get out of the meeting with Putin?
Putin definitely wants North Korea's help on the munitions. North Korea is one of the countries that has the largest stockpiles of weapons in the world, and they have these Soviet-era system weapons that are interoperable with Russia. So these are some of the artillery shells and even the anti-tank missiles that Putin can benefit of from Kim Jong-un. But what Kim Jong-un gets out of this meeting would be any arms deal would really benefit North Korea's faltering economy, as well as any food. They have been always seeking any humanitarian assistance on food. Also, he will need technology transfer for his pet projects like the submarine, nuclear-powered submarine, as well as the spy satellite that he has been wanting to put in the orbit.
Thank you so much, Bloomberg's Sang-Min Cha there on the very latest of this pretty extraordinary meeting. Now, coming up, Apple launches a new iPhone today. We'll bring you all of the details on that and, of course, their Qualcomm chip deal. That's next, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back. Now, Apple's latest iPhone will be unveiled today at 10 a.m. California time. The company will also sell a made-in-India iPhone today for the first time. Now, the MacBook and iPhone maker also just renewed their contract to get modem chips from Qualcomm. Joining us now for the very latest is Matt Bloxham from Bloomberg Intelligence. Matt, we're all excited. I know Qualcomm is a big thing, but come on, tell me what's in the phone. Is it going to be like super good, super different?
Well, I don't think it's going to be super different, certainly if all of the kind of rumors we've been hearing are true. And I guess in the last few years that the rumors tend to be pretty accurate. So I think, expecting the usual kind of lineup of 4 phones spreading from the kind of the standard to the kind of Pro Max. I think the interesting thing this time is given that shipments of smartphones have essentially plateaued, here it's about upselling people to the pricier phones. So we think pricing might go up across the range, and certainly at the top end could be a few $100s more. So maybe we're even inching towards a $2,000 phone, which would be quite something. But ultimately, Apple needs to kind of sustain revenue growth or go back to revenue growth from revenue slump. It needs to get people to upgrade to more expensive phones. So the features in the higher end phones might also be substantially different from the lower end phones to encourage that upsell process.
So are they really focusing also on India? Because China, I mean, it hasn't been great news coming from China.
Yeah, I mean, I think they've been trying to focus on India for quite a few years, and I think definitely that'll be part of the story too, because it's a huge market. That's clearly an area where you need to be selling cheaper phones because of the kind of average disposable income. Yeah. And so at the lower end of the range, and you start to see them kind of shift some of the kind of better technology into cheaper phones to kind of lure people into the the Apple ecosystem.
Yeah, and once you're sucked in, there's no going back. Talk to me about Qualcomm.
Yeah, so they kind of re-signed this deal, which I think was a surprise from the Apple perspective and Qualcomm. So this is about 25% of Qualcomm's revenue. So you've got another 3 years of revenue that perhaps a lot of people didn't expect them to get. I think from the Apple perspective, there's a perception that maybe it's taken them longer to transition to their own silicon in this area, which maybe means some of the more exciting features that you'd expect Apple to develop in-house may be a bit slower to come onto the market than people were hoping.
Okay, Matt, as always, thank you so much for joining us. Matt Bloxham there from Bloomberg Intelligence. Now, Bloomberg has also learned that UK's Everton Football Club is close to an agreement to be acquired by 777 partners following months of talks between the parties. Now, the club owner, Farhad Moshiri, is expected to exit with just a fraction of the money invested. Now, for more on this, let's get to David Hillier. David, you're the one who broke the story, right? It's like it's been months of your reporting, talking to sources. So first of all, why is Moshiri selling?
Well, Moshiri's been at Everton since 2016, and it's been an unmitigated disaster for him, really. He spent hundreds of millions of pounds, most of which has gone on players who just haven't performed as well as he or the fans would like. The other thing he has done, though, is he's built a new stadium on the dockside in Liverpool, which will be incredibly impressive, and that will be his legacy. But he's been looking to sell for a couple of years now. I mean, things have got so toxic with the fans that board members were advised last season not to attend games because the police feared for their safety.
So what are 777?
777 is a Miami-based financial company, primarily was an investor in aviation and insurance. 21 months ago, one of the co-founders, Josh Wander, decided that COVID had presented a great opportunity to invest in football clubs that had been laid low by COVID. And he's built up a big stable of European teams.
Including Genoa.
Including Genoa,
which is my team, so I don't know whether I should disclose that or not. But so what are these multi-clubs like 777 actually set up to do?
Well, I mean, the idea behind them is that they kind of pool resources. So they have a holding company, which then does all sorts of things in the centre, like data analysis on player recruitment. They do multi-sponsorship deals across the company, and they kind of try to benefit from economies of scale. And there's a lot of them, about nearly 300 clubs in Europe now are part of a multi-club setup.
And so, David, overall, when you look at some of these games, this is not for the Manchester United, right, of these worlds. It's like some of these smaller companies that they can, I guess, unlock value. Are we going to see more of these medium-sized clubs being acquired?
Yeah, I mean, but it can also be big teams as well. I mean, Chelsea, which was bought for 2.5 billion, has recently bought Strasbourg in France. So it's an idea. Manchester City Football Group has got 11 teams across the world. So it's big and small. But on the medium-sized to small size, the owners say that it's one way of kind of competing with the state-owned bigger clubs.
Thank you, David, for, of course, all of your breaking news and terrific insight into this fascinating world of football. That was David Hellier. Now, in other football news, Lionel Messi is buying a waterfront mansion in Florida, costing almost $10.8 million. Now, the soccer superstar, football superstar, will zero to the U.S. by a blockbuster contract. Messi joined Inter Miami earlier this year in a watershed deal for U.S. football that saw him spurn an offer from Saudi Arabia. Now, let's also take a look at what events we're following today away from football, although I know we're all obsessed by football. In a couple of minutes, 10 a.m. UK time, it's Germany's ZEW survey. There will be particular interest in this release, given concerns about the weakness of the country's economy. That's, of course, followed by Brazil CPI at 1 p.m. Inflation set to rise again in August to near the upper limit of the target's tolerance band. And lastly, BOE policymaker Catherine Mann is due to speak at an event in Ontario on post-pandemic economics. Up next, Bloomberg Surveillance Early Edition, Shonali Bazak in New York, Danny Berger in London, and this is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Bankers prepare to stop taking share orders for ARM's IPO, which is already 10 times oversubscribed. Meanwhile, Apple gears up for a high-stakes iPhone launch. UK jobs data for August showed another record month for wage growth, putting more pressure on the Bank of England to raise rates again. And JP Morgan CEO Jamie Dimon hails U.S. consumer resilience, but he is also taking aim at U.S. regulators, calling for more humility. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London, alongside Shonali Basak in New York. Shonali, we've got ZEW, if you're American, Germany survey coming in. Investor expectations for the month of September, better than expected, still not great. A negative 11.4. The estimate had been a negative 15. We'll get more into that later. Shonali, that's all the data for Europe, but in the U.S., we're still waiting for that all-important CPI tomorrow.
Yeah, we're just about a day away. And when we wait for that CPI data, we are looking at some weakness in the S&P futures on the day today. We're watching at the S&P down about 0.2%, a little more than that. We are watching yields back on the rise ever so slightly ahead of that critical print, as you've been saying, 499 handle on the 2-year. This is a roughly flat, but a tick up from where we started the day yesterday. The Bloomberg Dollar Index partly on the rise as well, can explain your movement in yields just ever so slightly. A huge story here. Brent crude crashed above 90 last week, now above 91. You are looking at Brent crude up about 0.6% on the day. I told you we'd keep an eye on crude all week. We certainly are. I want to flip up the board because there's a big global story also, Danny, that is in Country Garden. We're looking at shares that have risen in Hong Kong trading after the Chinese property developer, very intimately ingrained in markets in China, very critical to homeowners. They want approval for creditors to extend repayments on 6 UN bonds by 3 years. Now remember, that news came roughly a week after last-minute repayments of dollar securities, and the most recent developments have driven the Hang Seng Index higher. That index ultimately traded lower on the day. However, it did get a tick up from the initial news. Country Garden has also since pared its gains so slightly, but still up almost 4% on the day.
Yeah, still other deadlines there for Country Garden to worry about that repayment on Thursday. Shonali, I want to get back into the ZEW investor expectation surveys, which I just mentioned. Okay, The good part of it is that expectations, that is what the situation will be going forward, are not good, but better than expected. The estimate was for -15. It came in at -11.4. However, it is the current conditions of the ZEW that are worrying. The estimate for that was a -75. It came in at a -79. In other words, those investors surveyed in Germany see their current situation very bad. It will get a little bit better than expected, but still it's the concern here and now in Germany. The euro continues to weaken versus the dollar. It's down by 1/3%, not moving too much off of that survey because it was already down a whole lot. Giving back the gains we had seen yesterday, we're going into the scenario where currencies are moving more off of growth expectations, and those expectations and reality are weak in Europe. The 2-year yield, this is an interesting one, a big rally in gilts. We had some UK jobs data come in. Unemployment ticked higher, so the job market looks softer there. However, we did see wage growth stay at 7.8% year over year. That is another month of a record. Why is the wage story not cracking? And why are we getting a rally in the front end off the back of that? You'd think we would sell off. Perhaps we've now expected that this is the peak in wage growth. Surely it will move down with unemployment. And Shinali, quickly, European stocks, those giving up the gains for the day, they're basically flat to a little bit lower.
Meanwhile, markets are awaiting, as we've been talking about, the latest U.S. inflation print just a day away and the next Fed decision about a week away. In the center of an uncertain future for interest rates, the team over at Bloomberg's podcast Odd Lots asked PIMCO co-founder Bill Gross on whether there's a new bond king in town. His answer was an unapologetic blast at DoubleLine's founder, Jeffrey Gundlach. For more, let's bring in Bloomberg's Valerie Teitel. Valerie, is this the call, a call that the next bond bull market just can't be as big as the last?
Well, in that Odd Lots podcast, Bill Gross did comment that it was the function of the 30-year bull market that did propel him to earn that nickname, the Bond King. But in that statement that he made about Gundlach, he shot back at Gundlach earning that same title, saying, to be a Bond King or Queen, you need a kingdom. PIMCO had $2 trillion under management. DoubleLine has $55 billion. Come on, that's no kingdom. That's like Latvia or Estonia. Quite some shocking remarks from Bill Gross that was made to the Odd Lots podcast at a conference in California. Now, Gundlach does attend the same conference today. Let's see if there's some scathing words he has back for Bill Gross. But Bill Gross, widely known as the Bond King, definitely earned that moniker by taking PIMCO's total return fund to the biggest in the world. And I remember my days being on a trading floor when that PIMCO line rang, you shook in your seat. So it was definitely well earned. That being said, this bad blood between the two arose when Bill Gross left PIMCO and confronted Gundlach on the possibility of working together. And Gross said that Gundlach trashed him for the next 12 months. So perhaps some scathing words from Gundlach due back today. We'll be listening for those, maybe crossing the wires.
Yeah, PIMCO, not exactly the best reputation when it comes to, shall we say, their kindness dealing with bankers. Also, so mean to Estonia and Latvia. Wonderful countries. I would love for that to be my kingdom. Okay, so if Gundlach isn't the Bond King, where does the next generation of bond royalty come from?
Funny you asked that, Danny, because he did mention that the next generation of bond kings and queens are at the Fed, saying that the Fed is in charge. And we find out tomorrow with that U.S. CPI print if exactly the Fed is in charge of this inflation picture in the U.S. It has been looking good for the Fed. They've gotten those 2.2% month-on-month core CPI prints. We might get that third one tomorrow. It is looking like the Fed is in charge for now.
Valerie, thank you so much for that. Also, only you, Valerie, could take this in what's kind of a gossipy story and tie it to reality. I love it. Valerie Teitel there from our markets team. All right, after the regional banking turmoil earlier this year, U.S. regulators have proposed higher capital requirements that had been slammed by J.P. Morgan CEO Jamie Dimon. Dimon pointed finger at central banks in an interview at the Barclays conference yesterday.
The Federal Reserves have a little humility. They're the ones that told the world rates aren't going up. And it wasn't the Federal Reserve in general, it was each one of them independently. In fact, it was each central bank. So if I were them, I'd have a little more humility over stuff like this.
Will Shaw, Bloomberg finance reporter, joins us now on this. Will, this isn't the first time he's lashed out at some banking reform, saying, private equity will be dancing in the street about them. What exactly are the banking reforms that he is so opposed to, and when are they going to come in?
So bankers complaining about regulation is a bit like sailors complaining about the sea, but obviously this is Jamie Dimon, so people take it very seriously. So the Federal Reserve and other US regulators have indicated that they want banks to hold billions of dollars more in capital reserves after the collapse of several smaller lenders earlier this year. Now, for the 8 biggest banks, that's the like of Citigroup, JP Morgan, Goldman Sachs, that could mean holding nearly 20% more capital than they do at the current time. Now, the regulators, obviously, they say that will make the banking system safer. The bankers counter that this will make it harder for them to reward investors with share buybacks, which they did to the tune of $137 billion between 2020 and 2022. As to when these reforms will come in, it's likely to be between 2025 and 2028.
Well, let's talk about the biggest of the smaller banks, if you will, because on one hand, you have Citizens saying that they are trying to avoid a fire sale and unloading $9.2 billion worth of securities. And you have Truist starting to embark on job cuts, significant job cuts to try to trim expenses. How much pressure is there still on the regional and kind of mid-sized banking system?
Well, I mean, from those two firms, it looks like quite a grim outlook. At Truist, the CEO, Bill Rogers, said yesterday that the firm's performance was disappointing to investors, and on top of that, it was also disappointing towards him. Now, that's the 3rd biggest regional bank by assets in the US, so it's a significant measure to look at. As for Citizens Financial Group, like you say, they've indicated that they will avoid deals that mean booking losses as they seek to cut a $14 billion portfolio of unwanted loans. So in that particular area, the outlook is not looking great at the moment, even after a bad start earlier this year.
Bloomberg's Will Shaw, thank you so much for your time. Now, ARM's IPO is planning to price its shares tomorrow, but it's closing its order book a day early because of such high demand. It's oversubscribed by 10 times. Joining us now is Bloomberg MLive editor Eddie Vanderwalt. Eddie, just because it's oversubscribed to this degree, does that mean that its valuation is certain to get a lift on the gates of its trading?
Sonali, there's a lot of maneuvering that I sense below the surface here. On the one hand, right, it is great for any IPO if it's oversubscribed. It's much better than clearly if they don't have demand. But at the same time, why talk up the demand so much if you've already got the demand? Why leak that there is so much demand out there? And at the same time, this is a fairly small part of the, small slither of the company that's being sold. So a lot of investors being forced, fund trackers and so on, or tracker funds and so on, that need to buy whatever is in the indexes. So I think it's a little bit more nuanced. But one thing is sure, this is a test case for overall whether there is strong demand for the AI chip narrative that we've seen developing, and that has been so important in driving markets upwards over the last few months.
Eddie, I wanted to get into that because there's a lot of nuance about chip companies, what exactly they make, what they supply, whether they're the things that make the chips that make the things. When we look at ARM, what specifically is it telling us about chip demand? Is it AI demand? Is it something else?
Right, they're not a classic, really a classic GPU maker. They're not somebody who competes at that level where they're making these chips that would be used to drive the AI revolution. They tend to be used much more in lower end products, much cheaper chips used by Qualcomm, used by companies that make mobile phones. That traditionally has been part of the primary part of their target. Now, however, they seem to be pivoting. We heard from the CEO that they're looking towards much more higher end, much more customized, much more demand specific kind of chips. So they're trying to reposition themselves at the same time as launching an IPO. And I think that's a tricky, a trick to pull off. It's much easier to say, hey, this is what we're doing, this is working, and that's why you should be buying into this, than saying, hey, we're doing something else, we're going to do something different in the future. So there's a little bit of mixed messaging from this IPO.
Well, the good news is that big IPOs are back. I think we at least got to hang our hat on that. Eddie, thank you so much for joining. As always, Eddie Vanderwalt there. All right, coming up, North Korea's Kim Jong-un crosses into Russia for a rare summit with Vladimir Putin. We're going to be discussing that with the chairman of the Munich Security Conference next. And Gordon Shannon, 24 Asset Management Portfolio Manager, will be joining us later this hour. We're going to get into UK markets following that jobs data. Plus, we're also keeping an eye on Apple shares as we count down to the tech giant's high-stakes product event coming later today. For the first time, the new iPhone model you buy on the launch day could be made in India. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Shonali Bastick is in New York. Now, North Korean leader Kim Jong-un has arrived in Russia by train ahead of his meeting with Russian President Vladimir Putin. The U.S. says the talks will focus on supplying weapons to Moscow. Let's get more on this and how it fits into the wider geopolitical developments with Maria Tadeo, who's standing by with the chairman of the Munich Security Conference. Maria.
Yes, indeed, and that is, of course, Ambassador Christoph Heusgen, who joins us here in the studio. Thank you so much for being with us here on Bloomberg TV. I want to ask you, first of all, because we all know that, of course, you worked very closely for many years with Angela Merkel. You've done every possible meeting when it comes to international diplomacy, so you know exactly how a communique gets done. I want to get your reaction to the G20 communique. It seemed to me there was a lot of disappointment, particularly from the Ukrainian side. Is that fair?
Well, there was disappointment, of course. They would have liked to have the same language as last time around. But the question was, do we, in the end, have a statement or we don't have one? And I think there the opinion was, let's have a statement, let's have a strong statement, and on substance it is strong. but come out at this as united. And I think it would have been a bad message if the G20 had not agreed. So I think it's very good that the G20 stand together. Modi, of course, is a winner there, but also those who are not there are kind of the losers. Putin is a loser. She is also a loser because Modi was able to get this conclusion.
And when you say, because you've said a lot of interesting things in a minute there, but just to break it down, of course you say it was important to get a communique, even if that meant maybe softer language. A lot of people interpreted the language as softer in Ukraine. Lavrov, the Russian foreign minister, he said it was a success for Russia, this meeting. Is that propaganda? Is that what you're saying?
No, but when Lavrov opened his mouth, he lies. So what do you expect? Would he say, no, we can? Of course he says the good. But when you look at the substance, it clearly says national sovereignty has to be guaranteed. So this is number one. Number two, it pointed to the resolution of the UN General Assembly. And this resolution was a resolution where 141 countries condemned the Russian invasion. Only 5 countries stood by with Russia. It was clearly repeated, just is not called. Of course, Ukraine would have loved it. I would have loved it. But it's very important that we have the G20 united behind the UN Charter. So that was good.
And you said to me, Modi was a winner. Xi Jinping was the loser because he didn't show up. Some say that is wishful thinking from the West. And that is a narrative that maybe we like in the West. But you seem to be convinced the winner there was Modi.
He was, of course, a winner. I mean, this was a Modi show. When you were in the town, they had these billboards, all around, and he has elections next year. But he has managed this meeting. He got a conclusion. Some didn't want it. Actually, when you heard briefings before, said no, there will not be a conclusion. They agreed to it, and she wasn't there. And you could see that now Modi can present himself because there are very important things also for the so-called global South in there that he is representing.
The leader of the global South?
There's no leader, because they are all, there's not one leader. They want to be the leader. The Indians want to be the Chinese, but it's clearly there is not one leader. And this was demonstrated. So she seemed to be the leader after the BRICS because he was a big star. Now he was not there. And Modi is the one who got also topics on the agenda that are important to countries in Africa, Latin America, and Asia.
And you mentioned Latin America. I have to ask you about the Brazilian president, Mr. Lula, because it seemed he said Vladimir Putin will be invited to the Brazilian G20 that will take place next year. He also said, quote, if I'm president, he will not be arrested because of that ICC arrest warrant. Then yesterday scaled back. In your view, and I ask you because you've done G20 meetings countless times, will Vladimir Putin be in Brazil next year, hosted by Lula?
He will not be there because Brazil is a democracy and they have a judiciary. And Brazil has signed the international, the statute of the Rome Statute, the international criminal law, and it is clear. And already the Brazilian judiciary has said, no way. When he comes, he's going to be arrested because this is our Brazilian international obligation. Same thing in South Africa. Ramaphosa, the president, wanted to have Putin, but then the judiciary said, no way, we're going to arrest him. So this is a strong sign about international law.
So you say no Putin at the G20 in Brazil?
We can bet on this, yes.
You can bet on, so maybe Lula spoke too fast.
Yes, he spoke too fast. I think he's very emotional. You have to understand that Brazil, comes from a left tradition. They had suffered in Latin America a lot. I have to say that from American interventions, breach of international law by the U.S. in Panama, in Grenada, in Salvador, Nicaragua, all this. And they call it double standard. And they say, well, we have all these sanctions to do because of Russian invasion in Ukraine. But, what was about the U.S. in Latin America? So this is something that one has to bear in mind, and we have to cater to this. And this is why it's so important, coming back to the conclusion that international law, UN Charter, this is a base for everybody.
And of course, that is maybe a change in sentiment between how the United States sees their relationship with Latin America, but also those feelings that are still present in some countries in Latin America. Of course, this is still a sentimental issue. I do have to ask you 2 questions that I'd be curious to see what you think. Obviously, we know today there is a meeting between Vladimir Putin and Kim Jong-un. Is that PR, the bad guys get together, or is there something strategic here that you should go, it is worrying?
It is worrying, but it also shows, and this is the point, that Putin is a very, very strong leader. And Kim Jong-un is a very, very strong leader. And this is why it's so important, coming back to the conclusion that international law, UN Charter, this is a base for everybody. And of course, that is maybe a change in sentiment between how the United States sees their relationship with Latin America, but also those feelings that are still present in some countries in Latin America. For example, how desperate Putin is. He now goes to the outcast, the one that has huge sanctions by the United Nations. There are sanctions committee, you know, and so he's going there because he's desperate. He has lost his friends, so he turns to Iran, he turns to North Korea. So it's a sign of desperation.
So you don't see it as maybe there's something concerning when it comes to the weapons.
Of course,
is
it's
that a
concerning.
step too far?
It is concerning, of course. I mean, as I said, he's Kim Jong-un is an outcast. He's violating international law. You see what he does with his population. He's building, trying to build a bomb. So this is not good news, but it shows how far Vladimir Putin is ready to go to save his skin, to even go to somebody who is, as I said, an outcast, and look at what he does to his population.
And now as a final question, going back to your home country, Germany. Look, yesterday, the foreign minister of Ukraine, I was struck by some of the language when he was doing a press conference with the German foreign minister, Annalena Baerbock, and he said, look, there's a question of the Taurus systems. Obviously, Ukraine wants them. Germany could give them. It still, or seems that Germany is still debating. And he said, ultimately, there's always a pattern. Germany says no, then they will think and think and think, and then ultimately they say yes. My question to you very clearly is, should Germany provide the Taurus now?
Absolutely. I'm absolutely in favor of it. We
Why is
have
it
to
not,
do
then?
it. Well, I think it has to do a bit with the German psychology, our social democratic party that have been the party that always thought about somehow we can, you know, by trading, by talking, we can get Russia to be a good partner. And their world has crushed, you know, all of a sudden there is Russia, the aggressor, there's nothing you can excuse, but still there's some hesitation. Should we do this? So all the steps went according to the Kuleba formula. So asking, and it's, you know, we should do better and go.
And will
go
happen
ahead
this year? Just very briefly, you think it will happen this year?
Again, I'll bet that it will happen this year.
Well, Ambassador, thank you so much. Of course, that is Christoph Heusgen, German ambassador, and also the chair of the Munich Security Conference, which I know you're working on, and that's why you're here in Brussels. So thank you for joining us.
Thank you very much for having me at Bloomberg.
Agenda.
It's a pleasure.
Appreciate
Yes,
it. Thank you so much. And of course, that was Ambassador Christoph Heusgen joining us here on Bloomberg TV this morning.
Maria, thank you so much. A great and timely conversation. Maria Tadeo there. All right, let's get some of the other stories that we have our eye on this morning. Heyman Capital founder Kyle Bass says American banks will lose hundreds of billions of dollars amid changing workplace trends. Take a listen.
And I think the banks in the U.S. will lose $250 billion in office over time here. And there's about $2 trillion of equity in the bank. So it's like a 10% hit to U.S. banking equity. And is that evenly distributed? Probably not. If it were evenly distributed, it wouldn't be that big of a problem. But I really think the focus on losses in U.S. commercial real estate is going to be in the office sector.
Shelley, this isn't exactly a controversial call. Maybe the actual number on it is, but office commercial real estate is something we've been worried about for a while. Unless you have that really prime type of real estate that people actually want to come back in the office for, there is already pain and folks handed back the keys, and even in some circumstances.
And it's not just even in the United States. We know we've seen issues from Sweden to Canary Wharf on the same degree. And, you know, on one hand, this is a hard hit to a lot of regional banks, could last a couple of years. But on the other hand, it's a gain for a lot of private equity firms as well. And speaking of the fund management industry, Danny, I want to bring you the latest in the hedge fund world and deals, because we have Sculptor Capital Management. The board is being sued for an alleged breach of fiduciary duty while trying to engineer a $639 million acquisition proposed by rival Rhythm Capital. Now, investor Gilles Beauchemin said in a lawsuit that Sculptor CEO Jimmy Levin and other directors shortchanged investors by using NDAs tied to the deal to prevent shareholders from considering a higher offer. Remember, investors including Boaz Weinstein, Bill Ackman, Mark Lazary, and Jeffrey Yass have been reported to have offered a higher bid for Sculptor.
And over here in Europe, Shonali, Norway's wealth fund has upped its stake in UBS to 5%. That's just below BlackRock's, which disclosed its stake just above 5% in a filing on Tuesday. Now, the fund's investment in the Swiss lender was just above 3.3% at the end of last year. Look, allocating more to UBS, I mean, the thing is a giant now, right? In Switzerland, it does make sense of the hold that this big bank has. If you want to bet on European banks, perhaps UBS is a good way to do that, Shonali.
Yeah, and it's not just the Swiss banking system you're investing in here. It's also a global banking system, given the exposure they have to Asia, right, Danny?
Yeah, although if you listen to Jamie Dimon, the banking regulations are coming to get you. Okay, coming up, we're going to be speaking to Gordon Shannon, 24 Asset Management Portfolio Manager. That's next. This is Bloomberg.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition, and here is what you need to know. Bankers are preparing to stop taking orders early for ARM's IPO, which is already 10 times oversubscribed. Meanwhile, Apple, it gears up for a high-stakes iPhone launch. UK jobs data for August showed another record month for wage growth, putting more pressure on the Bank of England to raise rates again. And JP Morgan CEO Jamie Dimon hails U.S. consumer resilience, but he's taking aim at U.S. regulators, calling for more humility. I'm Shonali Bassick in New York with Danny Berger in London. Danny, bring us to European markets today.
Well, Shonali, we were all ready to declare the death of the dollar rally yesterday after what happened in the Asia session not only meant a weaker dollar against the yuan and the yen, but also against European currencies. We're seeing that, not all of it, but to a large extent, undo itself today. The euro weakening against the dollar by about 1/3%. We're unable to get back to that 109 handle that we had seen on the euro. We're still struggling. It's the growth story that's really concerning. We also get an ECB decision come Thursday. 10-year yields in Germany, the rally is starting to ease. We got ZEW survey released at the top of the hour. Current future expectations rather were better than expected, so that kind of crippled some of the rally we're seeing. The front end does look to be selling off yet again. And then finally, European stocks
Not too much going on here, Sonali. We are just ever so slightly lower. What about U.S.? How is that session looking?
We are also lower on the day here. When you look at S&P futures, down more than 0.2%. This has been a slow September. When you look at the trading activity, it has been pretty weak. And then you look at the 2-year yield, you see a lift up once again. It is roughly flat, but it is hanging out just below 5% at 4.99, Danny. That is a little higher than we were at levels at this time yesterday. Now, the Bloomberg U.S. dollar index, as you've been saying, taking a leg higher, about 0.1%. This is reversing some of yesterday's weakness that we saw in the dollar. Brent crude, I believe this is quite stunning, now above 91. It is up about 0.7%, but that move last week into the 90 territory was a big move, and now we are seeing it on the rise once again. I also want to bring you some movers, because ahead of the U.S. trading day, we are looking at Oracle already down more than 9%, falling after reporting slower growth in cloud sales. We're also watching UPS because the CEO says the company will pay out the biggest portion of its new 5-year labor pact over the next 12 months while trying to win back customers it lost during the contentious contract talks, making it a challenging upcoming year. That stock is now down more than 1%. And Tesla is down this morning after rallying more than 10% yesterday for its biggest gain since January on that Morgan Stanley whopping upgrade. You're watching now Tesla down about 0.6%.
All right, yeah, that Tesla gain, I mean, that was crazy. It's worth what, like 1.5 Volkswagens? All right, let me bring things over here to the UK, because we got some wage and jobs data today, a couple hours ago. So unemployment, it is looking softer. It did climb to 8.5%, which is a record right now for the UK, save for the pandemic. But that blue line there, that is weekly earnings. That is wages. It held at 7.8% year over year. That is, again, another month of a record. But let me show you what the front end of the gilt curve has done. We are rallying today. At one point, we were rallying by about 9 basis points. We've come back a bit. We're lower by about 5.5, but this is still a market that's only pricing in one more 25 basis point hike from the BOE. And again, it pulled back on that slightly after that wage data. Let's get into this. Joining us now is Gordon Shannon, portfolio manager at 24 Asset Management. Gordon, what do you make of a rally and still hot wage jobs data?
Yeah. So I think there was something for everybody in the data this morning. As you mentioned, the tick up in unemployment, and the fact if we look at that on a 3-month rolling basis, there's definitely a trend there of more weakness in the labour market. But it's wages that the Bank of England really have to concern themselves with. Now, we can push aside the 8.5% total pay number because the ONS says there's a number of one-off public sector and NHS bonuses there, but that 7.8%, excluding bonuses, it's much higher than the Bank of England can tolerate. So I think the recent comments from Andrew Bailey, he wanted to be able to give us a pause here, or more than a pause. He wanted to be finished. He can't be finished.
I heard those comments and I was like, not again. Not again, Andrew Bailey. You've done this before and it didn't live up to expectations.
The one thing I'll give them is their projections for unemployment in Q3 were 4.1%. So 4.3% were ahead of that particular projection. So not everything they say is wrong to the inflationary side. But yeah, I'd lean a lot more into it's Hugh Feld, their chief economist, talked about the fact that core services isn't showing any signs of slowing. So I think that's more important than this idea that some of the other committee members have said that there's still a lot of lagged impact and we're already restrictive. Yeah, we are, but not restrictive enough. And Dr. Catherine Mann yesterday, she's got the right idea.
So someone pointed out to me, Gordon, that we're almost 1 year from the Liz Truss mini budget, which I don't know how that's possible. Time is honestly meaningless to me at this point. Obviously, there was so much volatility that became apparent in the gilt market. How do you think about UK assets 1 year on, your appetite, their attractiveness to you?
Yeah. So the big change we've had is a lot more fiscal discipline from the government. So that's a real plus. And I think I'd almost put that ahead of the rest of the globe in that way. Inflation, it's still an issue in the UK and more of an issue than Europe or the US. I'm kind of tend towards the bearishness, so I'm pessimistic globally, but I think there's a lot more pessimism built into the UK. So from that point of view, I think UK assets do have something to offer here.
I think that doubling down on the pressure on the gilt market is worth taking some time on. I mean, how much more pressure do you think gilts might feel ahead?
I'm tempted to say, when you look at the 6-month chart, the trend's your friend. Asset managers are positioned here for long-end gilts to give you a protection and insurance if we enter a slowdown. And I think that they will, but it'll be a pretty brief period. So you're going to have to be actively managing your book for that insurance policy to pay off for you. On the longer term, I don't necessarily think that the yields we've got to the moment are the highs. If we look beyond the QE period, they're not that abnormal.
When you think about wages, we started this conversation talking about the UK wages, but when you think about what's happening across the Eurozone, we are days away from that big ECB decision. What are you positioning for?
I think the market has underpriced the chances that we get a hike there. The last few days we've seen the market move to realise that it's a bit of a coin toss. There are two camps in the ECB, the hawks and the doves, and there are valid arguments for both of them. The hawks, who generally are in the core versus the doves in the periphery, are worried about a wage price spiral. Now, when you look at forward projections of what prices are going to do in the EU, particularly Germany, both camps will be well aware that they're going to come down. There are a number of base effects, a number of subsidies which were pulled away last year and thus caused prices to jump. We'll be 12 months on from that, so they will drop out. But nonetheless, retail expectations of inflation are beginning to tick up, and that will feed through into wage expectations. The professional expectations in terms of the five-year break-even on inflation, those have moved up. So there's plenty for the hawks to argue for that hike. I've been told if we don't get the hike, it will be an aggressively hawkish pause, whatever that means.
Gordon, quickly here, how do you feel about the CPI data coming out of the United States tomorrow and the potential to change expectations that the market currently holds?
I think we might get a slight tick up there. The oil price is pushed up. The US is wholly self-sufficient when it comes to gas, so the events in Australia won't matter there, but I do think we might see it tick up a little. Nonetheless, I don't think the Fed are going to do anything. I think the Fed are completely finished here. I think there are enough signs of slowdown in the US that their policy is restrictive enough.
Translate that to me and what you would do for the US curve right now. How are you positioning?
Again, it comes to this. Everybody seems to be positioning to make use of the long end as protection, and you can, but on a more short-term basis. I think there are a number of overlooked risks when it comes to the global economy, so it's important to have some kind of form of insurance, whether that's being in very high-quality credit or having some long-end bonds that you're willing to be tactical with.
Gordon Shannon of 24 Asset Management, we thank you for your time. Now coming up, Apple's hotly anticipated iPhone 15 is set to debut today. More on what to expect from Apple's product launch event next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Shonali Basak in New York. All right, Shonali, let's turn to tech. There's a lot going on today. One of them is that Apple is set to announce the latest iPhone 15 at its product launch event today. And for the first time, the new iPhone model you buy on the launch day could be made in India. Now, we're going to discuss this as well as the ARM IPO. We know that that's had a lot of attention, too. And at the same time, there's some Tesla news to get to. But of course, our next guests are going to be mad if I call Tesla a tech company. So let's not do that yet. Let's start with Apple. Joining us now is Alex Webb of Bloomberg News and Matt Bloxham of Bloomberg Intelligence. Thank you both so much for joining Shonali and me. Okay, let's start with this story about the made in India iPhones. Matt, let me bring this to you. What is the significance to have a launch of a new model that might be built in India if you're going to be buying it?
Yes, it's not the first time they've built phones in India, but the first time on launch day it will be available if the news is correct. And so I think this is a significant direction of travel for Apple, that it's kind of diversifying its production away from the China dominance. Obviously, with everything going on with the tensions with China, I think that's very important to reassure investors that they have supply chain resilience. And I think we'll expect to see India become a larger part of the kind of production. So I think it's a significant kind of vote of confidence, if you like, of Apple in India's ability to produce phones to the quality it needs and that its customers expect.
The ability to produce, but also the ability to sell. Alex, when you look at the ability for them to bring in customers after such a long slump, what is this new set of releases going to mean for them to start to turn the trajectory around?
I think the really fascinating thing is going to be pricing, right? Because the least price sensitive are inevitably the people who are going to be buying the Pro lineup. What we're seeing, at least according to our colleague Mark Gurman's reporting, is they're going to be doing a few things around the edges with the Pros, a little bit more functionality, a titanium case shell, which should enable them to charge an even more premium price at the very high end. And as we've seen stagnating unit sales, it's the ability to squeeze more dollars out of the units that they do sell, which is really able to help support the top line.
Do we usually see Apple price shares move on iPhone launches? I'm just trying to think how we should be geared up here in terms of market positioning. I feel like it usually doesn't. I don't know. I could be wrong there, though.
Well, it's always, buy the rumor, sell the news
Right.
is often the kind of adage with Apple. And unless there is some knockout surprise, that, in the past, that has tended to be the case. The thing that's still not quite interesting is seeing what exactly sends the price lower or sometimes higher. That, for instance, with the Vision Pro, when that came out, it was things like the pricing, knowing what the target market was going to be the enterprise. Those little moments sent the shares lower in that instance. It could be very different today if there is some pricing surprise that's very much to the upside.
Now, Matt, what do you make of this idea of the Qualcomm deal that they just signed as well? You were talking about Apple's ability to supply its own products here, but this is a sign that its own in-house chip designs are taking longer than expected.
Well, that's right. Yeah, I mean, obviously it's great news for Qualcomm. I guess it's another 3 years of revenue that maybe a lot of people weren't expecting they were going to get. And as you say, it suggests that Apple's own in-house development is taking longer. And I think coming back to what Alex said about, it's really important if you're going to charge higher prices that you're wowing your customers with amazing new functionality and technology. And perhaps it suggests that, some of those kind of really breakthrough technologies are maybe a little bit further out than we thought. But obviously they do have a lot going on with their own silicon anyway. So, I think it's perhaps a little bit of a disappointment for Apple, but I don't think it's too much of a problem.
While we're talking about chips as well, we know that the high-margin chips in the ARM arsenal, if you will, has been part of the pitch for the ARM IPO, which is, as we've been talking about, 10 times oversubscribed. How compelling is this pitch? And do you believe that the current valuation is more in line with the reality than what they were previously seeking?
Well, I mean, we'll have to see where the pricing does actually end up to kind of have a strong view about the valuation. But I guess what you can see, if it really is 10 to 15 times oversubscribed, then the management team has been a great job on the road, pitching people on the mid to long-term story, which is clearly about a much bigger market than just smartphones and into AI and Internet of Things. So they've done a great job, but that means they'll also have to live up to those expectations in the quarters ahead when they're releasing results as a public company.
Yeah, Alex, what do you make of that, of the pressure that they're going to face after an overhyped, not an overhyped, let me not editorialize here, a hyped IPO?
I mean, the story they've been telling heading into this seems to have been quite effective and building up the momentum. The real challenge right now is to demonstrate if people are buying that message that they really are an AI stock. It is not immediately clear that that is the case. The reporting from Ian King, our colleague who covers chip makers from San Francisco, he had a look at the deck, essentially, that the CEO, Rene Haas, has been presenting to investors on his roadshow, and they very much made this point that they are trying to essentially integrate more into what their customers are doing. So more precise architectures is what they're hoping to provide. That, therefore, could be a higher margin business. Interestingly, though, that is not specific to AI, right? That is just broadly what they do in CPUs. The fascinating thing here is when we look to this valuation, and we'll have a very good sense of it this time tomorrow, clearly, kind of on a historical basis, they've been punting for a multiple that's comparable to NVIDIA. If you look forward, of course, NVIDIA, its earnings are going to double, its revenue is going to double this year. That is not the case with ARM, even if it does get back on a growth trajectory next year after. So how investors compute that, no pun intended, sorry, is what will decide not just the opening price tomorrow, but how it evolves over the subsequent 48 hours.
You can make that pun because I was going to go to the supercomputer to compute that. The Dojo supercomputer, which Adam Jones over at Morgan Stanley upgraded Tesla on. Massive rally yesterday. 10%. Can you just give me your take on that? When I first saw it, I was like, maybe Tesla will move on this. I mean, the move was massive.
Yeah, look, Adam Jonas is a historically big Tesla bull. He has made some punchy calls in the past, which on valuation, which have proved to be correct, but not necessarily for the reasons he stated, right? He was very bullish about the prospect of essentially Tesla having a fleet of self-driving taxis. We're yet to see that happen. The supercomputer is fascinating. One of my takeaways from it is people talk a lot about the data that Tesla is able to pull from all its vehicles, not least the camera data that it has from where people are driving, and it can use that to train its model. The fact that they need this supercomputer suggests they haven't been doing it as well maybe as they would have liked in the past, right? Now, if they have this, maybe it gives them a head start. It gets them, gives them some advancement in that space. Because at the moment, when it comes to self-driving cars, they are absolutely lagging. Google's Waymo and General Motors' Cruise unit, sort of the market leaders technologically. This might give them a leg up in that space.
Our thanks to Alex Webb and Matt Bloxam. Coming up next, we're going to look at some of the market-moving events to watch throughout the day. This is Bloomberg.
is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer, Wednesday on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Shonali Bassick in New York with Danny Berger in London. Now let's take a look at what's ahead today because we have NFIB small business optimism data out in the U.S. at 6 a.m. Eastern Time. Then we'll get OPEC's monthly oil market report coming out at 7, and a host of bank executives, including Goldman Sachs CEO David Solomon, speaking at a Barclays event in New York City throughout the day. And Apple's long-awaited launch event in Cupertino, California at 1 p.m. Eastern.
Shonali, we're also today looking out for potential deal news coming out of UK football. Bloomberg has learned that the UK's Everton Football Club is said to be close to an agreement to be acquired by a Miami-based private investment firm, 777 Partners. For more, Bloomberg UK business reporter David Hellier joins us now on this. David, you've had great coverage of this. First of all, wait, is it 777 or 777? I should probably get that right.
777.
777.
Yeah.
Okay, it's a mouthful. Why would Everton's current club owner, Farhad Moshiri, sell Everton?
Well, he's had a very wretched time since he went into Everton in 2016. He's, I mean, unlike, you know, some owners are accused of not spending on players, he's spent a fortune on players. And he's invested, you know, hundreds of millions in Everton. But really to no avail. The performance on the pitch has been dismal. Not you know, I mean, another businessman who's finding it very tough is, you know, Todd Bowley at Chelsea, who they've spent $1 billion on players and they're struggling. It's not that easy. And as a result, Everton fans have been, there's been a toxic atmosphere at Everton. Last year, the police basically instructed the board members not to come to the matches, to take up their seats at the stadium, because they couldn't be certain of their safety. So I think he's basically just had enough.
Yeah. I mean, taking a step back, you mentioned Todd Bowley. I mean, the Americans are coming for English football, not just for English football, but for football in general. I mean, 777 is a great example of this. I mean, why are they interested in Everton and then more generally in buying up so many?
I mean, they see it, I mean, basically, I think on one level, they see it really as a multiple of revenues. It's so hard to get an NFL franchise. And when you do get it, you have to pay, like the Washington Commanders did, you have to pay really, really big bucks. In Europe, the multiples are a lot lower, but there's a caveat to that, and that is that the risk is massively higher, as you can see from this Everton situation.
Yeah. I mean, you can't have an NFL team be demoted, but you can certainly have it here. Yeah. David, such a great story. Please keep bringing us them. That's David Hellier. Again, reporting that as soon as today, we might have an announcement of this deal. Again, remarkable, as he mentioned, that if this goes through, Shanali, 10 out of 20 Premier League teams will be owned by Americans. We're coming for football.
Better for the valuations, but unclear whether it's better for the teams.
A very good point. All right, that's it for Early Edition. Surveillance is up ahead. We're going to be hearing from NY Fed President Bill Dudley, among others. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
Central banks around the world, both developed and emerging, are fighting inflation.
I really think it's about ECB policy, how that relates to Fed policy and this U.S. dollar.
The consumer remains strong, so there kind of continues the challenge that the Fed has.
The last mile is going to be hard, but I do believe that we are very much on that disinflationary trend.
I think we're in this very, hold your breath kind of moment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market slightly negative on the S&P 500. Big events through the next 24 hours. CPI just around the corner tomorrow morning. Before we get there, Apple in focus. TK, the iPhone 15 a little bit later this afternoon.
How many times are we going to hear one more thing today at this thing? We should have all worn black turtlenecks today. That would have
made us look better. To me, it's just a big marketing thing. I really don't care, except the Apple experts like Mandeep Singh are telling me this time around you got to care about it.
This equity market cares, doesn't it, given the weighting of Apple on the
Well,
S&P?
look what Tesla did
on the
yesterday.
Nasdaq?
Morgan Stanley comes out and goes, hello, buy me, and Tesla goes up, what, 10%?
Have you ever seen anything like that? An upgrade on the south side of a mega cap name and a 10% move off the back of it? What's the signal you take from that?
The signal for me is there are going to be other companies saying, please recommend us. It's a jumble here. It's Tuesday. Is anything supposed to happen today besides the Apple thing? Maybe not. NFIB comes out, but we're getting ready for this news dump that we get Wednesday, Thursday, and Friday.
Elisa, Tesla this morning, negative, just a touch. We're down. A softer move, mild by 0.6% lower.
Maybe the signal is FOMO hasn't died yet. Maybe the feeling right now is that people feel a little bit lost, like they're not getting it right, and that tech has sort of been the juggernaut that has kept on going, and that you can't really count it dead. So if someone says buy, you do it, and that seems to be what people are doing. I don't know what that says going forward, but that's what it says to me right now.
That's exactly what happened yesterday in a major way. Let's turn to the price action. Futures pulling back just a little bit. We're negative by 0.2%. Into the bond market, yields lower by a single basis point. Your 10-year 4.2742. And in the FX market, the euro here, Lisa, just a little bit weaker against the dollar, 107.24.
So 107 is the new level it's stuck at until, and we're going to get that until maybe on Thursday. 7 a.m., this is some of the other data that's coming out. The OPEC monthly oil report coming out, and underpinning some of the angst that we have seen recently has been oil. Brent crude climbing to some of the highs that we've seen going back to July of last year. 1 p.m. is the launch of Apple's iPhone 15. And Tom, you mentioned, why do we care? Is it going to be just a marketing event? I think it's more than that at a time where suddenly people want to understand what the next hot thing is in tech, because that's what's driven the entire equity market for the United States so far this year.
I'm a broken record on this. Everybody knows I'm chip-centric, and I believe there are new chips in here. There's new inner guts to the phone, which make it special. I don't know. I'm going to listen to the bulls like Dan Ives at Wedbush. I'm going to listen to the bears saying, slow down. I think we've been fair and balanced on that on surveillance, but we've been here before, and everybody owns it. Well, let me correct that. Retail owns it. Institutions are a little under-owned in Apple. Maybe this is the thing that makes them buy at the margin.
And we'll talk about whether India owns it as well later on. And today, the Barclays Financial Services Conference is happening in New York. Goldman Sachs CEO David Solomon is speaking at 2:45 p.m., among others, including the leaders of Wells Fargo, Barclays, and Deutsche Bank. I'm just curious to see whether we have any sense of that shift from Goldman Sachs, but more broadly, John, the cuts that we keep hearing about, is it just the sort of typical fall culling of the herd, or is there something deeper going on, especially given some of the credit concerns?
Looking ahead to earnings already, October 13th for JP Morgan, TK. I know you read that note this morning from Ben Laidlaw.
Yeah.
Next big stop for this market after CPI?
I really agree with this. Ben Laidlaw pointing out there's all this economic data. We're all going to overanalyze it. I think CPI tomorrow is a big deal. Great. He's looking at October 13th when we start the soiree. And let's be honest, he's bullish. And our first guest this morning is someone who's refamed that to a more bullish stance.
More bullish than he was.
No, but, when do people start popping 5,000 as a regular statistic? There's a real hesitancy to get up there near
5,000. What is this?
4,900 or 5,000. How about 5,100? Let's go. Raise it.
Greg Barrow of BNP Paribas. He was the biggest bear on the street. He was looking for 3,400. He's now looking for 4,150. Here's the quote. The outlook for this year was always predicated on the idea of seeing a recession in the US. I think we've been surprised at the resilience of the data here in America. Greg, I'm pleased to say, joined us right now. 3,400 to 4,150. Let's start there. What do you feel like you got wrong, and why do you think that's going to persist?
Yes, I think there's been three drivers of the market that have helped this outperformance that we didn't see coming this year. One has been the Gen AI story, so that's a much more bottom-up story, so it's linked to tech and the appetite here to chase those names. I think the second one was positioning. We were aware that people were underweight coming into this year, but I think the extent of the chasing of the market that we've seen has surprised us. And the third thing, maybe most importantly, has just been that the data's been stronger than we expected. Us, along with many in the street, were looking for a slowdown and looking for a recession this year, and it just hasn't manifested, and really that's a big driver of the unwind of the gravity of the bearishness in our call.
You've reset. You're still looking for a negative market based on this call at 4,150. Where are you anticipating the weakness comes from, given everything you've just told us?
So I really think it is this manifestation of the slowing in the economy. So we know that everyone was looking for a slowdown that hasn't manifested as quickly as we expected, but that doesn't mean that it's not coming. You know, the effect of the massive policy tightening that we've had is going to have an effect on the economy. It's just taking longer to percolate than people thought. This idea of excess savings being run down, we do think that the consumer is going to slow. So I think many of the reasons that we were cautious on the market, we still think a lot of that can manifest. It just might manifest at a slower pace than we'd previously expected.
You've been a complete class act on this reversal. I want to dig into it further, and that it's been led by 7 stocks. It's been led by big tech, among others. Ben Laidler, who's been dead on, a huge bull, says they will reaffirm and stay strong. With your new optimism, your new neutrality, and dare I say you're going to announce today that you're going to 5,000 SPX, are you going to do it with tech as a growth leader?
It's controlled pessimism at this point, I think. I think in terms of market leadership, it's hard to get away from tech. You know, there is this structural growth story. So if we're in an economy that is slowing, albeit at a more gradual pace than we anticipated, then the structural growth stories are those that are going to outperform. The issue with tech is how far it's rallied this year. So I think the story going forwards in tech is going to be about being more selective. So we see certain subsectors in tech, things like semis, that have rallied massively this year, that maybe might pass the baton a little bit over to maybe software or some of the tech infrastructure names.
So I'm wondering about the concepts behind your bear case and your bull case. They follow kind of traditional economics, where bad news is bad news and good news is good news. The bad news being a hard landing, 3,400. The good news being a reacceleration, 4,600. Why don't you think that a reacceleration would actually prompt more aggressive Fed action that could torpedo the market? And in other words, the sort of good news is bad news and bad news is good news. I know that Tom's loving this. But, you know, how much does that kind of come into play?
No, I think it's a really good question, because when we look at the correlation between equities and bonds, that gives us a bit of a window into that question. So you can look at bond ETF, something like TLT, so longer-term treasuries, and you see the correlation between equities and bonds really broke down in summer when the equity market rallied, and we've had a pickup again in that correlation, which kind of points to me this idea that equity valuations are again looking stretched relative to rates, and that does raise the risk that if you get a hotter print, particularly in, say, this week's CPI, that higher rates could be a headwind for equities. So I think equities are stuck between a little bit of a rock and a hard place, in that an economic acceleration, if it's too hot, starts to bring rates higher, and that can again compress PE multiples. But a slowdown is really the bear case. I think our bull case is pretty asymmetric. We're not looking for that much upside. We think that upside would be driven more by value stocks and cyclicals. If we have data surprising to the upside, I don't really think that's going to help the names that have outperformed this year and driven the rally so far.
So do you believe in Goldilocks, or do you think that this is people just sort of wishful thinking and picking a point along a progression towards something else and saying, just stay there?
I think it's very difficult just to stay in this benign Goldilocks environment. I think one of the things that we got a little bit wrong this year was just underestimating this kind of piece in the middle. You know, we had an issue with the data last year that it was way too hot. And our view was that data was going to cool and become too cold and take us into a recession. But ultimately, if you go from too hot to too cold, you go through a piece in the middle where things feel just about right. And that's where we feel we are. So we don't think the data is going to plateau here, and we don't think we're going to stay in this Goldilocks environment forever. This kind of controlled descent that we've had in the data, we think is going to continue to deteriorate and will morph into a shallow recession.
My great theme has been corporations will adjust. How linked, based on what you've been through the last 18 months, how linked is economic analysis with the securities analysis of the market?
I think that equity markets are always very linked to the macro, but there are these secular drivers that sit alongside that. When we go and look at any of the large crashes or bear markets over the last 100 years in equity markets, they're all accompanied with a swift economic decline. But that doesn't mean that we can't have these secular themes, things like Gen AI, that drive some dislocation. So I think part of it is the magnitude. You know, when you're in a more benign economic environment, the economy is not necessarily the primary driver for the market. If we do get to a situation around the turn of the year where we start to see negative payroll prints, then I think people's attention will divert, and people's ability to buy into blue sky thinking becomes much more challenged.
Are you allowed to talk about Apple?
We can talk about it loosely. Obviously, I don't.
Let me loosen it up. Let me loosen it up as follows: dollar stronger, China perhaps developing different tastes, nationalism shaping perhaps some patriotism at home away from foreign luxury items. Are multinationals in trouble here with exposure to China?
So I think how I can answer that is think about some of the general themes that we think about in terms of tech. Those stocks are going to be incredibly resilient in a downturn. Why? Because they have great free cash flow and amazing balance sheets. But that also doesn't mean that they are immune from a consumer slowdown. So one of the things that we think will manifest over the next 6 months is that this tightening of rates will affect the consumer. Now, the consumer is obviously, consumer discretionary is your first port of call, but there are a lot of tech stocks that do face the consumer. Ultimately, Apple sells goods and services to the consumer. So will they be entirely immune from a cyclical slowdown? That's the question.
It's like one more thing, except, it's encore une chose. When you're BNP Paribas, you say that. Of course, you say that.
That wasn't a great song as well.
I think
I'm sure that was a song, wasn't it?
Yeah,
sort of like 90s club music. Yeah. All right. Greg, thank you. Greg Battle.
Encore une
BNP
chose.
Paribas.
It's French.
Wasn't sure where you were going with that.
No, we're going to London next week. We ought to do Euro training thing to Paris. We should do the show from Paris.
You want to take the Euro tunnel?
Yeah, the Euro train thing. Yeah, you come
just to
out
Paris and back,
fields.
or do you want to do something in Paris?
No, I think we do the show.
Okay, with Greg.
With Greg. BNP Paribas.
All right, looking forward to that. Put that on the schedule then.
I can't focus.
Next week.
I can't focus.
Really? I'm shocked.
Everton or Everton? I mean, we got a new focus here at Surveillance on Everton.
It's Everton.
Everton, the Merseyside Derby. And they're going to be taken out. 3 guys in Pasco and Wander in 777 in Miami.
The blue half of
Maybe
Liverpool.
take 'em out.
And Tom, based on our reporting, I understand this would make it the 10th US-owned club out of 20 in the Premier League.
Yeah.
I find it fascinating because I think they see a real upside in the values of these football clubs. And I'll tell you why. This is the world's game. And if you look at the franchise value of a US sports team, there are so many that dominate the top 10, even though this is the game just for one country, which speaks to the power of this country.
Yeah.
I think that a lot of US-based investors see the Premier League as it. It has become immensely dominant in world football. And for that reason, Tom, I think they see a lot of upside to the value of these clubs.
At Pasco and Wander at 777, they can look at this as like 6-8 years of bolt-on. They sell it to the Saudis, right? Because the Saudis are.
There's only so many clubs you can sell to the Saudis, and I imagine they're going to tighten that up as well, Tom. But certainly America.
They haven't won this year.
America owns British football in a much, much bigger way.
Do the guys in Miami take a loss if they're relegated down? Is that a risk here?
Well, it depends if they monetize that loss, right?
I don't know. We're just covering this
but
because
certainly,
our chairman.
brand value is going to take a hit if they get relegated. Absolutely, that's always the risk.
Like
the Saudis ran that risk, by the way, buying Newcastle, and they almost got relegated.
But now they're good.
But now they're good. Yeah. They spend their money. They start to develop the squad.
For the day.
Is that it? We done? You want to talk
we're not
real?
done.
Let's talk sports, New York sports, because
Bloomberg senior management loves Everton.
Is that right?
Yeah, that's why we're
New York sports for a moment in time looked dreadful in the last 24 hours, and it looked like it might get even worse. The first drive, Bills-Jets, Aaron Rodgers going down, and you're just thinking, never mind his season over, Jets season over. Then they won the game. They won the game, TK. It looks like, I understand he's going to get a scan a little bit later today, Tom. It might be season over for Aaron Rodgers.
Yeah, we can make, it's not funny, but Hilarian's ready to step in.
I texted Mohammed last night.
He's ready to step in.
As soon as it happened.
See you, Cambridge.
I'm sure the Jets fans thought it was going to be more of the same. Another tough start to the season, but great win considering what happened at the start. From New York City this morning, good morning to you all. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The names that move markets are on Bloomberg.
There's a complete change in the labor market.
There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Look, could we touch $100? Of course we can. Are we expecting prices to average above $100 just yet? Without an outage, no. Things are slowing in the economy, but oil demand is still very, very strong, don't get me wrong. Saudi Arabia will keep supplies in check to ensure that inventories continue to draw. That's where we are right now.
That's exactly where we are right now. And Rita Sen of Energy Aspect speaking to us in the last week, a new high for the year on Brent crude in the last 24 hours, 91.45. Your price action shaping up as follows this morning, and good morning to you all. WTI crude, $88 and about 7 cents, positive by 0.9%. Going into CPI tomorrow, yields a little bit lower by a single basis point, 427.62. Looking ahead to the iPhone launch a little bit later this afternoon, Tom, equity futures negative here by 0.2%.
It's going to be interesting to see on a quiet economic day, but then the data piles in tomorrow. John, what's the latest zeitgeist on inflation? I mean, I looked at the headline, I get it, oil up and all that, but core is supposed to be, am I right, quiescent? Is that the right word?
Well, you've nailed it. You asked the question and answered it. That is the story. Two stories. Pick your poison. Yeah. Do you trade on headline, being firmer off the back of crude, or core showing signs of progress, Tom?
Yeah.
That's going to be the decision going into Chairman Powell and the Federal Reserve decision next week.
Let's frame all these themes together, but also take a bigger picture. As I stated, my book of the year is Robert Kaplan's The Loom of Time. I can't say enough about this. It is a chapter across all of the greater Middle East, and always Kaplan has one chapter that is phenomenal. It is on Saudi Arabia. To help us with Brent at 90 and on the reality of Saudi Arabia and $100 oil is Francisco Blanch. He's head of global commodities and derivative research at Bank of America Global Research. Francisco, you nailed oil. You got your 90, 91 Brent as well. The trajectory seems to be to 100, and very clearly that's what Saudi wants, is a domestic reality. They have budget requirements, fiscal requirements domestically. Are we going to see $100 barrel because Saudi wants it?
It's possible, Tom. I would say there's three things that have been moving oil prices over the course of the last 3-4 months. Supply, and supply. We've had Saudi Arabia cutting production for, as you know, close to a year now. And they started cutting in September of 2022 at around $95 a barrel on Brent. So clearly they want to have higher prices. They're trying to push the market there. What's new in the past few months is that Russia has finally started to align itself with Saudi Arabia and started to take production out. The Russians, after maximizing volume over price, over value for much of the past 12 months, they started to focus on price over volume. And that's a new development in Russia, I would say, in the last few months. And then also we've had a lot of refining issues, Tom. We've seen products, particularly diesel, leading the oil market higher. So those are the three main supply drivers.
One of the great things in Kaplan's book is the new linkage, not like 1986, but the new linkage between Saudi Arabia and China. Can China live with $100 a barrel oil?
Well, I think that the Saudis have always been very cautious about avoiding demand destruction episodes. And certainly, I think they will become cautious again if prices break through $100 a barrel, because as we saw last year with gas, with natural gas, if prices do get out of whack, you can lose a lot of demand. European natural gas demand from industry, remember, is lower today than it was at this time last year, with a 90% decline in prices. So you have to be careful what you wish for. If prices move up too fast, you can end up hurting consumption. And China today, as you know, is the world's largest oil importer by a mile. is facing a pretty weak economic outlook ahead because of the real estate challenges and the trade war with the U.S. and of course the tech sector also being down. So I think China is not in a great economic position to begin with. So I think OPEC Plus will be careful as prices rise.
Before we drill into the demand side, let's sit on supply just a little bit longer, Francisco. You mentioned a shift in Russia away from volume to price. What's underpinning that shift? Is that well understood before we make a call about how durable that pivot will be?
In my mind, the pivot comes after a very successful program set up by the U.S. Treasury to put a price cap on Russian oil. Remember, the price cap essentially encouraged Russia to export high volumes at low prices, which were then resold, redistributed across mainly India and China and other clients. But more recently, I think the Russians have figured out that the ruble is too weak, that the Russian tax authorities haven't been able to really raise enough revenue, and the macroeconomy in Russia has really deteriorated. And of course, we've seen that with tensions building up within the military and the paramilitary over the course of the past few months. So I think the conclusion that I believe the Kremlin is probably arriving to is that they need more money, and therefore the way to do that is the way to maximize revenue for the Russian tax authorities has been to pressure volumes lower and allow prices to rise. And the price of Urals crude oil, which was trading around $50 a barrel, is now approaching $80, well above the price cap set out by the U.S. and the European Union.
On our screen right now, Brent crude through 91. So, Francisco, let's talk about demand and build on the question Tom asked. It's an important one. Have we seen any sign of deterioration in demand from China, even with that economic weakness?
Well, the August numbers were phenomenal in terms of import increases. We saw China importing 12.5 million barrels a day on average throughout the month. Granted, imports in July were kind of weak, but what we hear from China, and I was in Singapore last week and at meeting all the various energy traders, the main message is that Chinese demand is pretty healthy. And to be honest, you see it in the data. You look at number of air flights, you look at passenger traffic. Demand's still pretty healthy. What's been weak is industry-related consumption. So think about gas, oil, diesel, and the petrochemical complex. That's been weak. But I think overall Chinese demand is in a better place. I think even though the real estate sector is not doing well, you still have a strong services sector come back after COVID, and that's supporting oil prices in China and crude runs as well. We've seen refineries running a lot of crude oil in China over the course of the past few months. So I think Chinese demand for oil continues to lead, frankly, the world. Most of the demand growth this year and probably next year will still come from Asia, and China will be the bigger part of that.
This goes against the narrative, which is that China's falling off a cliff, not demanding anything, and that this is entirely driven, that the increase in prices in oil is entirely driven by what Saudi Arabia is doing and maybe on the margins, what Russia is doing. If we don't have that narrative, what would stop oil prices from going higher, especially if demand continues strong from China?
Well, I mean, I think look, China overall, like I said, is coming back from COVID. If you look at international flights, they're still down 50%. Now, there's been a lot of tension between the U.S. and China over the course of the last few years, right? And for instance, flights to the U.S. remain very, very suppressed. But that's going to have to pick up. And we're also going to see a meaningful increase in China flights to Europe over the course of the next few quarters. So in my mind, I think the Chinese demand story from a services perspective is okay. I mean, GDP in China is not negative. I mean, it's weak, but weak means 4%, 4.5%. That still allows for growth in kind of the same things we did after in the West when we came out of COVID. Restaurants, going to the movies, traveling around. I mean, the Chinese consumers are doing that, and that's supportive of the oil market. And then, of course, to your point, I mean, the curtailments on OPEC have elevated prices, have brought inventories on a downward trajectory, and we expect that to continue. So again, we are targeting $90 a barrel on Brent for next year. That's the current market right now is at 86 for calendar 2024. So there is a little bit of upside in our view from current prices. But I think if you push too hard, the risk is that inflation comes back, and then the narrative that we're going to have peak rates with no recession goes out the window in my mind, right? So I think OPEC has to be considered also about, consider the effects on the macro markets, particularly rates and the outlook for a potential recession in the U.S. and the rest of the world.
Hey, Francisco, always a clinic. Brilliant. Thank you, sir. Francisco Blanch of Bank of America, speaking exactly to what Marko Kolanovic of JP Morgan talked about yesterday in his note, the potential for the commodity price surge to feed inflation and extend hiking cycles. More on that conversation still ahead. Lindsay Piegza of Stifel from New York City. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
No drama this Tuesday morning, pulling back just a touch on the S&P 500. We're negative here by 0.2%. Yesterday on the NASDAQ, best day of gains of the month so far. The month's still young. Got a big event a little bit later this afternoon. The NASDAQ this morning, Tom, lower by 0.2%.
And again, played off Tesla. You were talking about it as we went to air, John. I mean, the idea that any given sell-side firm can come out and say, let's go on ginormous stock like that.
You get a 10% move.
Like we've never seen that before.
Not just any firm, though. Morgan Stanley, not just any analyst, Adam Jonas.
Yes,
which is
true.
very closely followed in the auto sector. But I'm with you. To see a move like that off the back of a single call on the south side is quite something.
And to what Lisa mentioned with Francisco Blanch, the idea of what China's going to do, and I still think there's a conflation, Lisa, of the gloom, the tangible gloom of domestic balance sheet China with what they're going to do in terms of economic output. The answer is most of the people I trust say, you know, their economic output's not going to be that bad.
This might be kind of perverse, but maybe this is the downside of humility, that if people are very aware of what they don't know, someone just says a catchphrase and they say, oh my goodness, maybe I don't know that I should buy. You know, and that's sort of a question of how much rumor really fosters that, John.
FOMO, maybe some FOMO in this market, maybe. In the bond market, 2-year, 10-year, 30-year shaping up as follows. Your 10-year looks like this going into inflation tomorrow. Down a single basis point, 427.62. A 2-year still in and around 5%, 4.99 on a 2-year in America. Just to finish on foreign exchange, the euro shaping up as follows, going into the ECB on Thursday. A break of 107 in the last week, had a little look at 106, back to about 107.20. Negative on that currency pair by 0.3%. Yesterday, a ton of dollar weakness against the whole of G10, the dollar bouncing back just a touch this morning. Under surveillance this morning, Apple launching its iPhone 15 model later on this afternoon. And while the majority of new models will still be China-made, India-made phones will also be available on the first day of sale. That will be a first for Apple, underscores the company's growing use of India as a production base for its iPhones. Comes at a time, Tom, when there's increased tension with the US and China.
And this is not some CEO delegating authority. This is how Tim Cook became Tim Cook. This is what he does best. That was been emphasized. Mandy Singh mentioned that with Bloomberg Intelligence the other day. But to me, it's really something worth watching. Can the labor execute? Can they get out a zillion phones? Is the design there? Is the fit and finish there? Is the perfect Apple liddy cute little, you know, the little cutesy pie box?
Is that what you're calling it? A cutie pie box?
Yeah, and then the kids leave it. They leave it out so that
this feels
you can
personal.
see that
This feels personal.
yeah.
Pick a word: decoupling, de-risking, diversifying. What would you say Apple's doing?
Sending a signal to China that we have optionality.
Well, you know, the thing that I find fascinating is that in some ways, Xi Jinping gave Tim Cook a free chance to actually be emboldened and embrace other countries by basically saying you can't use the iPhone if you're a state employee. How much does this give Apple more room to maneuver with de-risking, diversifying, which they had been doing anyway, but they can make a bit more of a show about it just to talk about their prowess globally?
Earnings risk, Tom. Earnings risk. Let's see if this spreads in China. It's my big question in this quarter.
Yeah,
Are we going to see people flock into Huawei? Does Huawei have the scale to compete with China? Does it have the technology to compete with the iPhone?
I don't think we know on that, but what we do know is there's been this belief for years in every launch, every one more thing moment, the black turtleneck and all that. There's been this idea, OMG, Apple's dead, margins are going to decline. And it just, oops.
Yeah, it didn't happen.
They didn't decline.
Let's sit on margins. This story on labour costs. The United Auto Workers lowering its pay demands to 36% from 40%, so it's a very small shift. Thursday's deadline for a deal with Detroit's automakers is just around the corner. Bloomberg reporting the companies still see the demand as boosting labour costs too high. I'm not surprised by that, Tom. Just a softer stance from 40 down to 36 from UAW reportedly.
I wonder how they pick which one to strike. I'm fascinated by that. Is it like
you've said that a few times.
How many people
Who's
are
the
in the lot? You know, how many cars are on the lot? Who's, you know, which group of union workers will cooperate with union management? I don't know what the chemistry
I'm looking straight to the White House, TK. I can't wait to see what their response would be if we get a strike.
After the 48 hours they've had with the president now home, I don't know what his response will be. My head's spinning. I wonder what
based on what he's
President
told us,
Trump's response.
Based on what he's told us, the most pro-union president in the history of this country.
Yeah, but is the union with
do?
him? You know, Mr. Trump's going to come out and
find
play
out.
this strike as well.
We're going to find out. Final story for you. New York Jets fearing the worst after star quarterback Aaron Rodgers suffered a suspected serious Achilles injury just 4 minutes into his debut with the team. The 39-year-old helped off the field after being sacked in the first quarter of the Jets' 22-16 season-opening win over the Bills. Tom, this was not how this was meant to go yesterday at all.
Huge response. And, you know, I actually was talking to Paul Sweeney about this in the last hour of Surveillance every morning on radio. And, you know, the idea here, football is just ginormous. I mean, the numbers here, it was like the top 30 or top 40 programs last year.
And the good news, we actually were able to see this in New York, Tom.
Yeah.
If you had Spectrum, because
At
Disney
the last moment,
China got it together and agreed on it. Shock horror right before
4
Monday Night Football.
4 p.m. on the commute home as well. Right now, let's pick it up with Lindsay Piegza. This is perfect to come off of Francisco Blanche with $90 oil and the beautiful microeconomics he showed us. Let's continue this forward from Blanche to Piegza. And Lindsay, I want to go to the microeconomics of oil and